maybe just go straight forward to that. But we'll basically be covering today is that we're going to be looking at some of the ISB's major consultations that are planned for 2021. We're going to be looking at projects that are in progress already, and these will include the business combinations under common control, what the changes that are being thought about at the moment, possibly to IFRS 3. Don't know whether it'll be a new standard, but possibly IFRS 3 at the moment, the current business combination standard. And we'll also have a look at goodwill and impairment. We'll have a look at the Better Communication Project and the Disclosure Initiative Project as well, and how that is panning out at the moment, and what's changed so far, and some of the additional changes that we are likely to see going forward. We'll have a look at the post-implementation reviews that are being undertaken to IFRS 10, 11, and 12. Remember, we had the suite of 5 standards that were issued back in effective 2013. They were issued a few years earlier than that, and those will be coming up for review now to see whether or not the standards are working as they should be. And we are also going to be looking at financial instruments with characteristics of equity. So that project that is on the go at the moment. We'll have a look at recent amendments to IFRS as well. There was an amendment in February of this year to IS 8, the definition of accounting estimates and how that should be applied in practice. And I think as much as it's not yet effective, but I think there's some learning there that we can certainly take from in terms of how we then deal with our own any accounting estimates, or trying to figure out whether or not we've got an accounting estimate change, or we've got a change in an accounting policy in our organizations. There's also been amendments to IS 1 and to the practice statement that we have that deals with materiality, specifically looking at disclosure of accounting policies. So that's come through, and I think we are going to cover that as well as part of the session, so we are aware of it. Folks, if there is any, just give me a moment. I see there's some comments about no sound. I just want to make sure that I'm coming out loud and clear. If you don't mind just giving me a moment. If anybody else can hear me, if you don't mind just letting me know, please. Yeah, can you hear me? Thank you very much, Emma. Thank you very much, Dita. I see you guys can hear me. That's fine. Thanks, Mark. I am audible. For those of you who are not able to hear me, I suggest that you log off and you log back on again. Hopefully that should resolve it. If not, just send, if you're still struggling, because I can see there's a lot of you who can hear me. If you are still struggling, please see whether or not maybe it might be your internet connection or something that's maybe not strong enough. But I'm hoping that we'll be able to resolve it by simply logging off and logging back on again. All right. So let's carry on then. So just as a bit of housekeeping before we launch straight into this thing. So if there is anybody who has got any questions, I'm happy for you to put your hand up, or you can use the chat function and I can get your questions that way. And if you're happy to turn your microphone on and you want to speak to me, that's fine too. Just put your hand up and I will acknowledge you and I'll let you come in, and we'll take it from there. Good. So I think let's keep it as interactive as we possibly can. I am going to be looking this way every so often because I've got another screen that way. So if I do look that way for too long, please don't take that as being me trying to be not interested in what we're doing here. It's just that I'm looking at the screen because maybe sometimes what's in front of me may be too small for me to be able to read. All right. So folks, that's basically what's on our agenda for today's session. And we'll start off by having a look at what the ISB are currently working on. And I think some of you who have been in the session with me may have seen this slide before. The process that the ISB follow when it comes to the setting of standards. And I think for me, this is quite important that I think we understand this process, because we have an opportunity here to participate in each of these steps as we go along. So whether it be when they're asking for information, if we find out as an organization, we find that we have a particular scenario and we have a particular accounting conundrum that we're dealing with, but we don't know how to address it. well, we can write to the ISB and let them know about it. Maybe if they find that there's other people that are in a similar situation to where we find ourselves, they may then put out a request for information. That's the RFI that we've got there. They may then put out a request for information where they'll ask for other companies that are similar to ours in terms of, well, what are they doing about dealing with a particular matter? Is there literature out there that may have been put in place by various, maybe it might be accounting regulators around the world to try and deal with a particular matter, or maybe there's industry practice that we have come up with in order to try and address a particular matter. The one thing that comes to mind is for the miners, and they've got what they call streaming. So whether and they account for any streaming activities that they undertake. We don't have any guidance at all in IFRS. But the one thing that has happened over the last little while is that with the potential change to IFRS 6, this is one of the things that will hopefully be addressed in that. The miners have put this forward and said, well, we've got this issue with streaming. How do we deal with it? Can we find some sort of guidance on, can we be provided with some sort of guidance on this? And basically coming out of that, that would have come out of the request for information process. The next step that will then come out of that is that there'll be discussion papers that will then be put together. The discussion papers will then enable the ISB to start putting some sort of thoughts together in terms of, well, where is this standard? Where is this process going? I use the word standard there. I'm going to take that back. But where is this process going? And once there's an understanding of what the process is all about and what the issues are that need to be dealt with, everybody understands, well, yes, these are all the issues. We've got, we've included everything that we should be including as part of this process. Then the ISB will then work on the next stage, which is basically the draft accounting standard, the exposure draft. And in putting the exposure drafts together, they're basically saying, well, we have heard what everybody has got to say, and this is how we think the response to this matter should be. This is what we think it should look like. And putting all of this together will then enable us to then comment on it as users, as preparers of financial statements, to then say, well, yes, the ISB has hit the nail on the head in this matter, or they've completely missed the boat and we think that they need to go back to the drawing board and have a look at this again. And oftentimes this has happened in the past where the ISB have put together a standard. If I look at what was supposed to be the new leases standard back in 2009, 2010, that everybody looked at and said, oh, hold on, this is not working because of all these reasons, and the ISB has to go back to the drawing board. But then there's other standards that have come in, exposure draft is issued, and the next thing you see the standard has been finalized and no issues at all. But it all depends on what the issues are and how the issues have been captured and how widespread or how disparate the views are on a particular matter. Final standard is issued, and I think once the final standard is issued, folks, you can be rest assured that, well, making any changes or having any changes affected to it is going to be that much more difficult. So up until everything that happens, up until the process of issuing the new standard, we are able to participate in that process. And I would certainly encourage all of us, to the extent that we are affected by anything, to participate. Once the final standard is issued, it doesn't mean that the door is closed completely, but it's going to be a lot more difficult to open and have major changes made to the standard. But I am going to tell you about the post-implementation reviews just now, which do open the door a little bit wider for us to enable us to then to enable some changes to be made depending on what it is that we are finding is working or is not working in practice. In the meantime, while we're waiting for that post-implementation review process to unfold, if the standard is not working for whatever reason, then the standard setters might look at it and say, well, we think that there's a need for an interpretation to be issued. And this is where the IFRC comes in. So the IFRC will come in, the Interpretations Committee will then come in and they'll look at a matter and they'll say, well, we think that there's an issue here with the accounting for levies, and therefore we are going to issue an interpretation, IFRC 20, or they'll issue an agenda decision to say, well, we think that everything that is sitting in the accounting standard at the moment is appropriate and there is no need for us to go and do anything different. Now, folks, while I'm there and talking about agenda decisions, for those of you who may not be aware of it, agenda decisions are issued by the Interpretations Committee. And up until last year, agenda decisions were, for a lot of companies around the world, agenda decisions were optional. You didn't have to go and apply what is sitting in the agenda decisions. From 2020 onwards, agenda decisions have taken a different importance, have been given a different importance to where they've been before, because we are all required now to go and apply what is sitting in those agenda decisions. We can't ignore them. So because we cannot ignore them, well, we need to familiarize ourselves with what is sitting in those agenda decisions. For those of you wondering where it is that I'm talking about, or where we find these things, if you go onto the ISB website, they've got a section. If you look on the Interpretations Committee, under the Interpretations Committee, in there, there'll be a link to all the agenda decisions that have ever been issued ever since the Interpretations Committee has been in place. For those of you, if you're trying to look a little bit closer to home, you might want to look through your IFRS standards. If you've got the annotated version of the IFRS standards, that in there you'll see every so often there'll be a footnote that'll be provided that will support the accounting standards themselves, and they might have like an E1 or something, or E2. There will be some sort of footnote that will be included in the IFRSs, and in there. When you follow that footnote, it'll then explain to you, well, this matter was discussed at the Interpretations Committee in March 2015. This is what they discussed. This is the scenario that was put to them by whoever it is that wrote to the ISB. The ISB thought that the way to address this matter would be to point the user or the person who wrote to where in the accounting literature they think that the guidance is provided, and therefore there was no need to go back and change the standard. So they'll go and explain all of that and explain the thinking behind why they've issued the agenda decisions that they have. So agenda decisions don't change the standards. They don't result in the issuance of an interpretation, but they certainly give us guidance as to whether or not there is enough guidance. They certainly give us a view in terms of whether or not there is enough guidance in the accounting literature, or there is a need for additional work to be done elsewhere in order for somebody to be able to understand what is going on, how one should read what is sitting in the financial in the accounting literature. So that will be the work that the Interpretations Committee does. Folks, please just bear that in mind. Agenda decisions, we cannot ignore those. We need to be taking them into consideration. Agenda decisions are issued, or interpretations are issued, and now we're back on the horse again. We're well on our way to applying IFRSs, and every so often there's a need for us to go back and just take stock. Are the standards working as they should? Colin, I see you've got a question. Can I ask you to unmute yourself? Colin, I see your hand is up. Have you got a question, sir? Okay, maybe Colin does not have a question. Right, I'll move on then for now. So every so often we have a look to see, well, are the standards working as they should? And if they're not, why not? Is there a need to go back and revisit the standards, maybe change the wording here and there in order to make it more readable, to make it more understandable? What is the issue? So you'll see this year we've got a post-implementation review on the go at the moment for IFRS 10, 11, and 12, the consolidation standards. So this is what, 8 years after the standards have been issued that we're now going back and having a look at them. But there's also been other standards where there've been changes that have been made to existing standards, simply because have not been made to existing standards. What the ISB have done is that they've had a look to see, well, are the standards working? And if the views that they've got back are the standards are working as they should be. So because of that, there's been an acceptance of, let's leave the status quo. There is no need to go back and change any words at all. But again, that would have been an opportunity for us to then say, well, we don't like what is sitting in IFRS 13. We don't like what is sitting in IFRS 3, so therefore let's go back and make this particular change. While we're talking about IFRS 3, I did mention to you earlier on, We've got the issue with business combinations under common control, where we have group reorganizations and how those are, we don't have a way of dealing with them at the moment that is based on what is sitting in IFRS, because IFRS 3 scopes us out. So therefore, there's a need for us to go back and make it, there's been a need to go back and make a change to that particular standard. And the ISB are currently in the process of doing that. So when I look at what we've got on the research projects that are on the go, business combinations under common control is the one I've just been talking about. We don't have any guidance on group reorganizations. So therefore, there's a need for us to have some sort of guidance on that. Dynamic risk management, where you've got where you're undertaking hedging arrangements and you're managing your risk, but you're managing your risk using different instruments. Maybe you've got an instrument that enables you to manage interest risk, commodity risk, foreign currency movements, all in the same instrument. At the moment, again, depending on how complex your hedging arrangements are, sometimes we don't have sufficient guidance in IFRS to enable us to account for all those things in one fell swoop. So again, this is going to enable us to do exactly that. Extractive industries. I see there's a few of my mining friends that are on the call today. Onele, I think I saw you somewhere. This is a standard that's going to affect the miners. IFRS 6, as it sits at the moment, for those of you who may not be aware of the history of this particular standard, it came into being back in 2003, 2004. And at the time, we had a lot of the mining countries around the world adopting IFRS for the first time. And in adopting IFRS for the first time, they wanted a standard that would enable them to transition from where they were, so whatever GARP they were applying up until that point in time, onto IFRS, but that would then enable them to make that transition as smoothly as possible. But at the same time, there was also an understanding by the standard setters, by both national standard setters and the ISB, that getting the Canadians to do the same thing that the Australians were doing, that the South Africans were doing, that the Ghanaians were doing, that was going to take forever. And one way of dealing with this would be to say to them, well, anybody who's in this extractive industry space, whatever you are currently doing, we will let you carry on doing that. So we'll let you have an accounting policy choice that says, well, we're either capitalizing expenditure or we're expensing it. And as long as our accounting policy explains this to our users, and with time, we will go back and we'll revisit this and we'll put in place a standard that everybody will understand. So everybody across the world, doesn't matter what your jurisdiction is, we'll be able to all apply exactly the same thinking when it comes to this. So that's where we are. That's basically where we are at the moment. So as a mining company, whether I'm operating out of Botswana, I'm operating out of Zimbabwe, I'm operating out of Zambia, at the moment, I have my own way of, I choose which way I would like to account for my expenditure in my books. As long as I'm explaining it in my financial statements, that's all that is required of me. But going forward, this is going to change. And in it changing, I would suggest that the miners have a look at this. This is a project that the ISB are currently asking questions around, and they would like to get our feedback on. And I think given that certain parts of the world are more affected by this than others, I'd suggest that those that are affected directly certainly do participate in the project. Later on, I'm going to talk about goodwill and impairment, and I'll talk about some of the thinking behind it and where what changes are being thought about at the moment. For those of you, the older people in the class today, I think you guys would be aware of days when we used to amortize our goodwill. Don't know whether we're going back there, but that's certainly part of the thinking that we have that may potentially affect how we deal with some of these issues going forward. Okay, I see Colin asked this question in text. There is a database of decisions issued in the past, but which actual agenda decisions are current and effective, and the effective date of each, or is there a common effective date? So Colin, yes, there is a database of all the decisions that have been issued, and you will find that those decisions that have been issued, how I would suggest that you approach it. And let me see if I can find, do I have it open? No, I do not have it open, but maybe what I'll do is at tea time, And when we take a break for tea, I will open my standards, then I will show you exactly what it is, where you can find the agenda decisions and how to potentially read them. So as you're working your way through, whether it be IS16 is the one that comes to mind at the moment. If you have the annotated version of IS16, you'll see immediately in the opening paragraphs of IS16, there is an agenda decision, I think, against paragraph 3 of IS16, which explains the whole notion of do I have property, plant, and equipment, or is this investment? Is it inventory that I'm dealing with? So it addresses that particular notion, that particular annotation that a particular agenda decision that we have in IS16. So as you're working your way through the standards, anything that is still relevant, that is still currently effective, you'll see will be annotated in the standards. If you work off the list that we've got on the ISB website, again, that entire list includes stuff that is still currently active as well. But the only issue is that you would need to know that, well, an agenda decision was taken and it might have been taken in 2006. Now, that may be difficult to remember. So because of that, I would rather suggest that you work from the standards, but I'll show you how that works exactly when I share the standards with you a little bit later on. Okay. So where was I? So goodwill impairment, I started talking about that. They're also looking at some amendments to IAS 19 on pension benefits that depend on asset returns. They're looking at the post-implementation review. I spoke about that. And then there's also a post-implementation review on IFRS 9 relating to classification and measurement. The ISB is also thinking about the equity method of accounting and whether or not that is appropriate in its current format, and whether or not there is a need for them to go back and have a look at it again, make some changes to it. But again, some of these things I will touch in a little bit more detail so that you are aware of what's going on. Just on the list of things that are on the go at the moment, standard setting projects that are on the go, we're expecting the management commentary exposure draft to be issued in the second quarter of this year. I don't think that this has happened already. So I think we've still got a few more days to go before the quarter is up. Primary financial statements. There's been a consultation project that's been on the go for the last couple of years now, looking at what makes up our primary financial statements. I am going to ask you the question a little bit later on. And but the ISB are looking at making some changes to this, making some changes to IS1 as we currently know it, and whether or not that will ultimately result in the withdrawal of the current IS1 and the replacement with the new standard, we wait and see. Rate regulated activities. I don't know if there's any rate regulated people that are affected by rate regulation that are on the call today. I haven't seen on the names. See if there's anybody that I recognize, but certainly this is a big topic for discussion at the moment. It is open for comment up until the end of July. And for those of you who are maybe working in whether it be companies that sell maybe fuel or provide electricity, or provide services where the government, some sort of regulator steps in and says, well, this is how much you will charge, this amount and no more, then you may be in that rate regulated space and you need to look at this particular exposure drop to see how it might potentially impact you, because there are going to be some significant changes here, because they're looking to introduce what they call regulatory assets and liabilities, in that if you're entitled to charge an amount of money, if you, for whatever reason, don't make enough of a profit in a particular year, well, maybe you can recover whatever you don't make in a following financial year. Or if you make too much this current year, maybe the next financial year you will not be able to get as much of a tariff increase as you might otherwise would have liked. So that would then give rise to either an asset or a liability, depending on what it is that we're dealing with, or where you find yourself, and what it is that you're permitted to make as a profit in each financial year. So this, I think, from what I'm hearing at the moment from some of the feedback that I've got back, is that this is causing quite a lot of consternation around from the people that are affected directly by it. So folks, I think if you are in that space, I would urge you to have a look at that, please, and see what that might potentially do. On the disclosure initiative project, there's two projects that are currently being worked on. We're expecting an exposure draft either late on this year or an exposure draft that is out for comment already. Subsidiaries that are SMEs. This one I quite like because if I've got a parent company that is in the listed space, as that subsidiary company, I probably have to find myself in a situation where I have to apply IFRS, full IFRS. I don't have very much of a choice. But my reality is that the only people that are looking at my financial statements are my parent. But I'm having to jump through all these various hoops that IFRS requires of me in order for me to be able to prepare a set of financial statements that we can then say these financial statements are compliant with IFRS. But nobody else is going to see it. Even the regulators in my space, probably just the taxman who's looking at my financial statements, they probably don't need as much information as what my financial statements provide them with. So for subsidiary companies that are SMEs, the standard the standard setters are looking at this and saying, well, is there a need for these entities to provide as much disclosure as they're currently providing? So folks, if you are in that space, I would urge you to have a look at this, because this is looking to reduce the amount of disclosures that we're providing, still requiring you to comply with IFRS, but reducing the amount of disclosures that will be required of you. There are going to be some standards as well that are going to be revised. IS 19 on employee benefits, and we also looking at IFRS. The ISB is also looking at IFRS 13 on fair value measurement. So these ones are out for comment till October of this year. What they're looking to do here is use them as a pilot to say, if we are making all these changes as part of the disclosure initiative project that seeks to streamline the disclosures, that seeks to make the disclosures that are provided in the financial statements more effective, well, how do we achieve that? So let's start off by having a look at IFRS 13 and IS 19 to see what those changes would look like. So let's go and test run this in the market and see how people, what information people would provide us with and how they would understand the financial statements that are prepared on this basis. And then coming out of that, they may make changes to additional standards. But this is just the way we are at the moment. So again, just for you to be aware of it. Financial instruments with characteristics of equity, I'll go through a little bit more detail just now. And then we have the comprehensive review of the IFRS for SME standard. The exposure draft is out, something for us to be just be aware of that. And for those of us who are affected by it, we've got SMEs, or we've got SMEs as clients, or who are an SME ourselves, to be aware that IFRS for SMEs, we've already had 2 iterations of the standard. Back in 2009, when the first one was issued, in 2015, when the second one was issued, and now we're up to the 3rd revision of the standard. And again, the intention is not to make IFRS for SMEs change as often as full IFRS does, but to ensure that there is some sort of alignment between the standards, though, to the extent that simplicity is also maintained within IFRS for SMEs. So it's not about copying everything that is sitting in full IFRS into IFRS for SMEs, no. But to ensure that there is some sort of consistency, though, in the thinking behind the standards, so that if an SME entity, for instance, decides, well, they want to transition onto full IFRS, it shouldn't be that much of a train smash to do it. And at the same time, whatever it is that supports the information that goes into our financial statements, doesn't matter whether or not you understand full IFRS or you understand IFRS for SMEs. You shouldn't understand the numbers that are presented in a financial statement, in the set of financial statements, that much differently from one entity to the next. Sorry, just want to see if I can just fix this. Apologize, I didn't notice that there was this thing that was sitting there. Okay. All right, on the maintenance projects, there's a few projects that are on the go at the moment. For those of you who are from jurisdictions where there's Exchangeability of between your local currency and foreign currencies has been an issue. IAS 21 is being amended. The Zimbabweans come to mind at the moment, as do some South American countries that have got this issue at present. So lack of exchangeability has been an issue for some of them, with exchange rates being dictated by whether it be a central bank or being dictated by, or the exchangeability between currencies is quite difficult. So how do we then determine what the currencies are, what the rates of exchange of the between the currencies are, if we're not very clear about what markets these instruments are traded in? So IAS 21 is being revisited in order to address this, and there was a paper out that was issued a couple of months ago already, and I think it's got a exposure period till I think it's later on next month. So again, have a look at that if you have missed it. There's some improvements that are being made to the provision standard, lease liability in the sale and leaseback arrangement. Again, they're looking at clarifying some of the accounting for this, and then deferred taxes arising out of a single transaction, for instance, out of the application of IFRS 16, I apologize, where we are bringing on an asset, we bring on a liability, all at the same time, all in the same transaction. Well, what are the IAS 12 implications of that? Again, they're looking at putting something out there to enable us to deal with the accounting for that. So I'm not going to deal with every single one of those things that we've got on there, but just for you to be aware that there are some issues that are part of the maintenance project that the ISB is looking at that may potentially change what we're currently doing. Now, the one that I did say I was going to come back to and go through in a little bit more detail is the FICE project. So financial instruments with characteristics of equity. I have been on the Accounting Standards Advisory Forum since 2017, I think it was 2017, 2018. And since I've been on the ASAF at the ISB, this matter has come up for discussion literally time and time again, with feedback being provided about where the ISB or the board, the staff are with the project and where the direction in which they were going. And there were some areas where, the concerns were raised about, well, this is not going in the right direction, so they had to pare back a little bit in terms of what they'd done up until that point. But I guess the whole thinking behind this particular project is, is there a way that an organization can differentiate between a financial liability on the one hand and an equity instrument on the other? Simply. Oftentimes, and I get questions from clients on this, where trying to make that differentiation between a financial liability and an equity instrument is not an easy process at all to follow. If I go through the definition of a financial liability as we currently have it, contractual obligation to deliver cash or another financial asset to another organization, or to exchange financial instruments under potentially unfavorable conditions. So you and I enter into an arrangement where we agree 6 months from today, we will agree that I will give you my parcel of Vodafone shares, and in return, you will give me your parcel of Anglo shares. If we agree that that's what we're going to do, then we now need to look at this and say, well, what are these instruments worth? Today, they may be worth exactly the same. So my parcel of shares is worth exactly the same as your parcel of shares. But in the event that, as time progresses, as these shares continue to trade, we may find that my Vodafone shares are worth a lot more than your Anglo shares. So the prices are moving in completely different directions. But now I've got this arrangement with you that requires me, I can't wiggle out of it. This thing requires me to deliver my Vodafone shares to you. In return, you will give me your Anglo shares. So therefore, I find myself in a situation where I've got an arrangement to exchange financial instruments under potentially unfavorable conditions. I'm going to be sitting there with a potential loss on my hands, and you walk away with a potential gain. So you've got a financial asset. Whereas from where I'm sitting, I need to account for this as a financial liability because I cannot wiggle my way out of this. I have a contractual obligation. Or if I've got a contract that may be settled in my own entity's equity instruments, so if you and I enter into an agreement and we agree that I will issue you with W Consulting shares in order to settle my obligation to you. And my obligation to you is a non-derivative. So the value is not going to change. We know that I owe you $100,000. So therefore, I will issue you with however many shares are required in order to settle that $100,000. If we agree that, well, however many shares will be issued will be determined at some point in the future. If the shares today in W Consulting are worth $1 each, then we know that in a year's time, when I need to settle this obligation, because the obligation is $100,000 it does not change. If the price happens to be $1 a share of these W Consulting shares, then I'm going to issue to you 100,000 W Consulting shares, and we'll call it quits. But because we don't know how many shares are going to be issued, it then makes it a financial liability because the number of shares is variable. If the share price happens to be $2 a share, I'll only issue with 50,000 shares. So therefore, there's that variability that will exist. Or we may find ourselves in a situation where the obligation is a derivative. So what I owe you is a derivative. So it may be $100,000 today, but if the price of gold goes up or the price of gold comes down, that number may move from 100 to 110 or may move down to 95. We don't know what the number will be. But if we know that, well, this amount is a derivative, it will be settled. But how it will be settled is by me issuing you with W Consulting shares. If at the time that the settlement needs to happen, what I owe you is now worth 95,000 and the W Consulting share is $1 a share, then it'll be 95,000 W Consulting shares that will be issued to you. But if what I owe you is worth 110,000 and my share price is still $1 a share, then I'm going to issue you with 110,000 W Consulting shares. So again, because how many shares will be issued is not cast in stone, makes it a financial liability. So all of this that we've got at the bottom there, that's basically how to read that in plain English. Now that's different from an equity instrument because an equity instrument is something that evidences a residual interest in the assets of an organization after deducting all of its liabilities. So if I was to look at what we've just been talking about just now and try and apply that, effectively how we normally do it is that we say, well, if you don't have a financial liability, then it must be an equity instrument. So it's basically, the residual, whatever is left, must make it an equity instrument. But another way of looking at it is to say, well, a derivative is classified as equity only if it is settled by exchanging a fixed amount of cash or another financial asset for a fixed number of the entity's own equity instruments. So what I owe you might be 95 today, might be 100, might be 110. But if how I'm going to settle that is by me giving you 100,000 W Consulting shares. Whatever that price of those shares may be, we ignore that. But we know that it's going to be X number of shares that will be issued in order to settle this obligation. Then that's an equity instrument because you've predetermined how many shares are going to be issued in order to settle this obligation that you've got. And I'm using the word obligation because I don't want to use the word liability because it's not a liability, but I know that I am obliged to somebody for a certain amount of money. So therefore, I'm referring to it as an obligation because it could be an obligation in my mind, it could be a liability, it could be an equity instrument, it could be anywhere where I'm contractually bound to settle an amount of money to another party. So in looking at that, that's where the ISB is in saying, well, when we look at where we are at the moment, we need to make some changes to how companies apply IS 32 in order to clarify some of the thinking behind it, because as much as we've got those definitions, they're not always easy to apply. So the objective behind the project is to enable companies to have information, to provide information in their financial statements that explains the types of financial instruments that they have issued and how they've classified those particular financial instruments, and hopefully make it easier to then work out, well, what is a liability, what is equity, what is not. So the paper has been has been open for a while now. Well, it was open for a while now. The disclosure period came and went. So it was a discussion paper first of all. And where the ISB is now is where they are at the moment is that they're now starting to think about, well, do they go to the next stage, which is basically then issue an exposure draft. So we're hoping that something will come through in the next little while. But the process that the board has taken has basically been, or certainly I think the comments that have come through is that the board should be looking at this as if it's almost like on a binary approach. Do we either we have a financial liability or we have an equity instrument? And again, in looking at this, I guess they've been asking these questions that you can see in front of you here. So I'm hoping that you'll be able to make head or tail of this particular table. Do I have an unavoidable contractual obligation to transfer cash or another financial asset at a specified time other than liquidation? And if my answer to that happens to be a yes, then I'm going to stick with this first row for now. So if I'm looking at this first row, then I ask another question. Do I have an unavoidable contractual obligation for an amount that is independent of the entity's available economic resources? If my answer to that happens to be a yes, that's a financial liability. If it happens to be no, it's also a financial liability in this scenario. Where the difference comes in is that if I'd answered no to that first question, that unavoidable contractual obligation, then if the amount that needs to be paid, I know exactly how much it is, then it'll make it a financial liability. But the minute I don't know how much it's going to be, then I might as well be dealing with an equity instrument. So this is basically, I think, where the thinking is going at the moment. And again, for those of you who've got these odd-looking instruments, Tanya, I see you're on the call. I'm looking at you at the moment. This may be something I think that you may want to give some consideration to see what is it that is informing the thinking that the ISB is looking to apply here. Right. Early on, I mentioned the extractive industries, extractive activities project. Again, what the ISB is doing here is gathering all our thoughts on it. Anele and the Dipsona team, I see you guys on. This is something that I think you guys should certainly be paying attention to. I did mention it earlier on. What the ISB, they initially started doing some work on it about 10 years ago, which didn't go very far. So they've basically just restarted that process now. And in restarting that process, hopefully that will then result it'll culminate in the issuance of an actual standard. And I think that once that is done, hopefully we'll have a standard that will then be able to apply a lot more with a lot more clear principles across different entities in different jurisdictions, which we don't have at the moment. Thankfully, I think you'll find that within jurisdictions, people have generally found a way of working. So it's easy enough to compare companies that are within the same jurisdiction. But as you know, with mining companies, they generally operate multinationally. And that makes it a little bit difficult, especially where companies that do one thing go and acquire a mine that does another company that does a completely different thing. That you now need to go through the entire process of having them change their accounting frameworks and the accounting policies and so forth. And that's not always an easy thing to achieve. But under IFRS 6 or the new replacement to IFRS 6, hopefully we'll have a little bit more guidance in terms of what we should be doing there. Rate regulated activities, I started talking about this earlier on, so I won't spend too much time on this. But basically, it's about that. If you are in that rate regulated activity space, is that what the rate regulators, what the regulatory authorities within your organization, that's a bit of a tongue twister there, when they do tell us what prices to charge and so forth, that's going to have an accounting impact on us. So like I said to you, is that resulting in either a regulatory asset or a regulatory liability on our books. Now I'm bringing on this regulatory asset or bringing on the regulatory liability. There's going to be a lot of judgment. There's going to be a lot of, do we understand the legislation? Do we really have an asset? And I guess that's where the question is for a lot of people, is that do we truly have an asset on our hands when we are recording this, our ability to charge more in a future period, or if we have charged, made more profit in the current period and will not be able to charge as much going forward, does that then mean that we have a liability on our books? So that's where the questions are being raised at the moment, and hopefully this will then resolve it once this particular project is done and dusted. Colin, I see you got a question. A simple principle should be that an equity instrument should only be those shares that have actually been issued, i.e. a person is a registered shareholder. Those that are planned or expected to be issued are not equity, as there has yet to be established any rights to any residual. Colin, I would agree with you, but to an extent. If I've got a contractual arrangement in place that effectively makes me a person that shares in the residual, that currently makes me a person that is able to share in the residual, then should that not also entitle me to being classified as an equity participant in an organization? So I guess it's those sorts of things that I think we need to be aware of, and I think that we need to be questioning as part of this process of putting the standard together. Colin, I would suggest that it does sound to me like you're an ideal candidate to participate in these processes. Please do, to the extent that that you can. I know a lot of the national standard setters have got processes in place to comment. Please do comment, because I think it will be necessary to have all of these views out there so people can, so they can be taken into consideration. Okay. SMEs, I spoke about this already. So where the ISB are at the moment is that they are looking to see what jurisdictions would permit the application of a lower level of disclosure in the financial statements, and whether or not there's any additional disclosure that may be required in order to meet the requirements of various jurisdictions, so that when the standard does come out, if it does come out, if there are any amendments, that you're not going to hit too many legal hurdles in terms of its application. So that's where we are at the moment. Dynamic management, I spoke about this one as well. So where you're trying to find a way of dealing with the accounting for macro hedge arrangements that may be in place, where you're dealing with more than one risk and you're managing it on a portfolio basis. At the moment, not a lot of guidance out there, but hopefully with this particular project being completed, that will then give us some guidance in terms of what it is that we should be doing. Right. Folks, are there any questions for me at this point in time, apart from Colin? Anybody else got any questions for me? Happy for you to put your hand up or to type something in the chat, and I'll be happy to respond to it. Okay. I spoke earlier on about the post-implementation review of IFRS 10, 11, and 12. And you'd all be aware that, with the issuance of these three standards, we would have changed our approach in terms of how we consider, the questions we ask when we're trying to determine what standard is appropriate to us to apply. So I've got an investment in another organization. My first question I need to ask about that investment that I've got in another organization is, do I have control over this entity? If I have control, then IFRS 10 will then say to me, well, consolidate. If I don't have control, then my flowchart would then take me down the joint control route. And there I'd ask the question, well, if I've got joint control, then what sort of joint arrangement is it that I've got in place here? Is it going to be a joint operation, or is it a joint venture? And again, depending on which one I go with, they will have different accounting outcomes. Joint operation means I then account for my share of assets, my share of liabilities, income and expenses. If I conclude that I have a joint venture, then I'm equity accounting. I go to IAS 28. If I concluded there at this juncture that I don't have joint control, then I would ask the question, do I have significant influence there? And if my answer to that question was a yes, I do have significant influence, then I'd go to IAS 28 and I'd equity account. But if I answered no to this question around significant influence, then I go to IFRS 9, because all I've got there is just a plain old investment in another organization. So it's an equity investment that I've got in another organization. So therefore I go to IFRS 9, and IFRS 9 would then say to me, well, you can, because it's an equity instrument, you either carry it at fair value through P&L or at fair value through other comprehensive income. But if I choose to take it at fair value through other comprehensive income, well, then I'm stuck there. I can never change my mind. Gains and losses I take through other comprehensive income. Dividends and those sorts of things, that when those come in, those go through my income statement. That's what IFRS 9 will then tell us. So this is basically, I think, the flow chart that that one would need to use in order to try and make decisions about, well, where exactly do I sit with this particular matter? So what the ISB are doing here is that they're saying, well, we've been through all of this. This is what we have been applying. Is it working? Is it not working? To the extent that we think that there's a need for us to go back and make changes to certain aspects of IFRS 10, 11, or 12, well, what do we do? Oh, sorry, what I didn't mention here is that then all the disclosures that we're making out of the decisions that we've taken out of all of this are coming through in IFRS 12. So if I'm applying, if I'm consolidating, if I'm if I'm accounting for this as a joint operation or a joint venture or an associate, and applying IAS 28, then all the disclosures are in terms of IFRS 12. So is there anything in there that is not working as it should? And if there is, well, what is it that we need to go back and fix? So folks, I know there's some of you out there that have found some difficulty in the application of the standard. To the extent that you've not been able to find resolution for it, please do participate in this process, because it certainly is giving us an opportunity to ensure that some of those things that we are finding are problematic can be resolved. Where we have found that things are problematic is that when it comes to consolidations, as an example, there's two areas that come to mind immediately. When do I consolidate? If I'm sitting there as a 35% shareholder, I'm the biggest shareholder, do I have de facto control over this entity? If nobody else pitches up to meetings, if nobody else is participating in the decision-making processes, does that then mean that I've got de facto control? So that's one of the questions that has come up often, within organizations, to say, well, should they be consolidating, not consolidating? Well, what happens if things change overnight and all of a sudden the other people are participating in the decisions of this organization? Does that then change their position? Something else that has also come up is, well, how do I make a distinction between a joint operation and a joint venture? It was the subject of an agenda decision. I think it was an agenda decision taken in March 2015, if I'm not mistaken, where that clarity was provided. But maybe there's a need to provide that information in the body of the standards themselves to make it easy. So you and I establish a joint arrangement, and it's not set up in a separate vehicle. So it's you and I working in our personal capacities in order to have this vehicle up and running. And this vehicle is very dependent on us as for us to be able to give it its life. So whatever this vehicle is making, the output is being bought up entirely, well, mostly by you and I. Nobody else buys this. It buys its output. If this vehicle goes and borrows any money in order to finance whatever it is that it is doing, it is reliant on the revenues that it is generating from us to be able to pay back whatever amounts it has borrowed from third-party financiers. So for all intents and purposes, is that joint arrangement that we've got not an extension of us? Now, if I put that same arrangement into a separate vehicle, one would be tempted immediately to say, well, that sounds like it's a joint venture because it's sitting in a separate vehicle. But this separate vehicle is very reliant on you and me for its going concern. So because it's reliant on you and me for its going concern, then isn't it an extension of you and me, making it a joint operation rather than a joint venture? So again, it's that sort of thing that is not dealt with in IFRS at the moment, in IFRS 11 at the moment, and possibly should, in order to try and make it a little bit easier for people to understand what it is that we are currently doing. So that's a one post-implementation review that is currently on the go. Another one that is currently on the go is pension benefits. Again, with this one, they're looking at making amendments to IS 19. And so this is a narrow scope research project that has been, with the intention of it is to address some types of pension benefits that are paid that depend wholly or maybe partly on the returns that are generated by a specific pool of assets. So while one applies IS 19 normally and dealing with all of this, and when you look at the returns that are generated, so you'll see in the application of IS 19 now, we've got the interest income, interest expense that is generated, and that is based on a discount rate, from like, bond instruments, basically high quality corporate bonds. That's what we're looking at for that 5%, for that return that we got in here. And in this case, it happens to be a 5% return that is earned. But when it comes to the discounting of liabilities and all of that then make up this obligation that we've got, so everything that you can see here in red is effectively an obligation. That discount rate is not always going to be based on that same 5% rate. The assets have got a 5% return. The liability, the discounting, is not on the same sort of basis. So when you now discount present value, the amount, to then work out what your defined benefit obligation is, there is a mismatch between the measurement of the plan assets and the measurement of the defined benefit obligation. So because of that, the ISB are looking to go and have a look at this again to see, well, are we doing this appropriately? Is there another way that we should be recognizing and measuring this defined benefit obligation to work out so that there is a bit of a matching with the approach that is taken to the application, to the recognition and measurement of the plan assets. So this is an amendment to potential amendment to IS 19 at the moment. I don't know how many of us have still got defined benefit schemes on our books or in our clients' books that may be affected by this, but where we do, again, please just be aware of it. This is something that I think would make a significant change to how they approach the accounting for defined benefit obligations going forward. Excuse me. Then comes something that I'm quite passionate about, which is a better communication and financial reporting project. So the ISB have been working on the Disclosure Initiative project and the better communication and financial reporting process for a while. They've dealt with the materiality and how we determine what is material and what is not, and how that should be dealt with in our financial reporting. But basically, the central theme behind what the ISB have been trying to do over the last little while is focusing on the primary statements and what makes up the primary statements, focusing on the disclosures themselves, and making sure that what's in the back of the financial statements, what's sitting in the accounting policies, is addressing the user requirements, the requirements of the users of these financial statements appropriately, and also making sure that whatever stories management are telling around their financial statements, that there is a link between what is sitting in that management commentary section and what the rest of the financial statements are telling us. Now, you may look at this and say, but none of this is new. None of this is new, but I think we'd also gotten to a point where we'd all started using the standards as a checklist and simply putting stuff in, and whether it made sense or did not make sense, I guess our concern was, if IFRS says this thing is required, well, is it there? Where it is placed, how it is placed, the context, could the context be better? Could we draw a line between what we put in note 3 with what was sitting in note 15? If that was necessary, we probably never did it, because we simply wanted to make sure that if somebody is looking for a particular disclosure, can we show them that it is sitting in note 3A? If somebody is looking for a disclosure on something else, can we show them that it is sitting in note 15? The fact that we could have put both what is sitting in note 3 and what is sitting in note 15 in the same note, it's probably of no consequence to us. We completely ignored that. We completely ignored that. So we're saying, well, we need to go and change that. And in changing that, what we're looking to do is to address 3 things. Not enough information that is relevant, too much information that is irrelevant, and sometimes the communication is ineffective because, well, we just haven't drawn that line between the different things that are being done. So what the ISB is looking to do is taking into consideration that as preparers of financial statements, you are going to have to apply your judgment. But in applying that judgment, there must also be disclosure. The disclosures that we're providing in the financial statements must result in people understanding what it is that we're saying and why we're saying what we're saying. So do we have improved disclosures? Do we have better communication coming out of it? So the first place that they looked at was that they looked at materiality and the definition of materiality. And I think while we've had a definition of materiality for donkey years, it's always been in IS1, but tucked away in there, but it's been in IS1 all these years. But how do we define materiality and how do we apply that in practice? So I'm going to spend a little bit of time talking about materiality and how that is defined. But before I do that, I would like to ask you guys to all whip out your phones for a moment, or if you've got some other device that you can use to scan the QR code in front of you, and if you can answer that question for me. For those of you who don't have devices that can scan, if you go to that address at the top there, paulev.com, type that in your search bar on a browser, paulev.com/golden windows 397. If you type that, it'll then enable you to then respond on this particular question. Diedrich, I see you've got questions. Anyone else getting any audio feedback? Is anybody else not hearing me clearly? Just one answer would be great. If there's anybody else who's got it. So Emma, thank you very much. Emma seems to think that she's okay. Diedrich, if you don't mind, maybe just jumping off the call and jumping back on again. I'm hoping that will resolve the issue for you. Okay, but while we're waiting, if you guys could answer this question here, please. Materiality. The word material is synonymous with significant. True or false? Okay, I can see we're making progress. 40 results. How many of us are there on the call today? See, there's people been jumping on and off. Oh, there's 156 of us, so we'll certainly need to have a lot more answers than what we've got at the moment. We are stuck at 42 for now. Don't understand why we went backwards for a moment there, but we went backwards. All right, I'll give you another 15 seconds to respond, then I will close the poll. But let's see how we are progressing at the moment. Ooh, neck and neck, pretty much. With the trues and the falses are all giving us the answers here. Five seconds, then I'll need to close this thing off. Okay, let's see if we can hit 60 responses. We're down to 58 at the moment. Okay, there we go, 60 responses. It's 40%, but no, we could have done better than that, guys. All right, so if we have a look at where we are, I'm going to lock the poll now. 46% say material is synonymous with significant, 54% say no. I guess in my mind that was to be expected in a way, because I guess depending on how what hat you're wearing, as auditor, as preparer of financial statements, we all have different views in terms of how we in terms of how we look at the definition of the words that we've got here. But the one thing that I would like to just point out, and you'll see later on as it comes up, is that there have been some changes that have been made in the accounting standards that remove the use of the word significant and replacing it with the word synonymous. So in actual fact, the word significant has been used in the past in a way that makes it a synonym for the word material. So in the focus now being on materiality, the ISB has now certainly taken those words out in some of the standards in order to make sure that the application is then consistent between the different types of entities. Okay. Whip out your phones again, ask another question. Materiality is determined by the auditor. Management must apply the auditor's materiality threshold in the preparation of the financial statements. Again, can I see you guys' responses to that? Dierix, I hope you're coming right. See, other people are responding to you, that they can hear clearly. Right, 40 people so far. Come, we need another 20 people. Let's beat the last record. Okay. Ooh, what did I just do there? There we go. I am so glad for this particular response. Because so many times I often come across people saying to me, no, this is what our auditors told us and that's what our materiality is. Oh, the auditors haven't told us the materiality yet, so we don't know. Folks, if you're a preparer of financial statements and you don't have your own way of determining materiality, well, I think I'm lumping the entire fault around you having to do additional work on yourself. Don't look to the auditors at all. Auditors have they determine their own materiality for their purposes, for them to be able to say, well, these financial statements truly fairly present whatever it is that they say in the audit opinion. But for you as a preparer, you need to have your own benchmark that then allows you to then say, well, this is what I do. This is why I do it. This is why I do what I do, in order to enable the users of my financial statements to understand what it is that I'm making adjustments for, what I'm not making adjustments for. So we need to have our own materiality as preparers of financial statements. So folks, when I look at what's happened with the Disclosure Initiative project so far, thank you very much for those responses. When we look at what's happened with the Disclosure Initiative project so far, there have been amendments to IAS 1 and IAS 8, specifically around the definition of materiality. The materiality practice statement has been issued, practice statement number 2. I will come back to that later on in this session. We'll talk about some of the thinking that is in that practice statement. Now, with the practice statement, it's not a mandatory document. We're not required to go and apply it if we choose not to. But folks, I would recommend that you have a think through it. You have a look through it and think about it and what impact it might potentially have on you as an organization. And one of the things that they've done to this materiality practice statement, which I think will be quite important for us, is that they've made some changes to it in the last year or so that will then enable us to use this as a basis for then saying, well, when we are trying to work out what information we're going to provide in our financial statements, whether it be on our accounting policy statements that we make or the disclosures that we provide in the financial statements, what should we take into consideration? There's a little bit more guidance in there than we've previously had, which I think could be quite useful for us. We've also got the better communication case studies that were published. They've been around for about 4 years now, but I think are still quite relevant. And you'll see, for those of you, if you go and have a look at them, they are available on the ISB website. If you just type in that better communication case studies, it'll come up. Have a look at the examples that the ISB have put out there. They've had a look at people, various companies around the world. There is a dairy company from New Zealand, I think it's Fonterra, that they looked at. There is a ITV from the UK. There is a Pandora, I think, as well, from reporting out of, I don't know which of the European countries, but they've gone and they've picked a whole host of people that they've looked at and they said, well, when we look at the disclosures that where these guys used to be with where they are now, this is where we see the change in their reporting, the improvement in their reporting, and we think that this is the way to go. So in providing all of that information, I think that for me, is testament to the sorts of things that we should be taking. We should be taking a leap out of. So the pages we should be taking a leaf out of in order to try and ensure that we are also headed in the right direction. There've been amendments to IS1 to remove barriers to the application of judgment. Now remember, with judgment, we're also required to go and explain what judgment we apply and why we're applying it. There've been amendments to IS7. This one I think was quite important on the cash flow statements. For those of you who were in the cash flow statements session with me a few weeks ago, you know that I talked about this at length, about the introduction of the reconciliation of opening to closing liabilities, the changes in the liabilities that would have occurred in a particular reporting period, including those that have got non-cash flow impact that we might have lumped into our cash flow statements before. And we say, well, no, those things don't belong in there. Those need to be taken out. So again, with this additional disclosure, hopefully then enables people that are looking at our financial statements to better understand what it is that we're doing and why we are doing it. So coming back to this judgments, and especially when those judgments are pervasive, an organization is required to make materiality judgments on recognition and measurement issues. So making a call as to, do I capitalize, do I expense an item of property, plant and equipment? What value do I recognize as being capitalizable? What do I not? Again, it may meet the definition of property, plant and equipment, but simply because of the threshold that is not being met, I might take a view that, well, I'm going to expense that. And I often see companies will have a policy in their financial statements that says any expenditure above whatever the amount is what we capitalize. Anything below that, we expense in the year of acquisition. Folks, that's absolutely spot on. Nothing wrong with that. Whether you want to incorporate the amount, the value in the accounting policies may be up for debate. But to the extent that you feel that it's important to enable users of your financial statements to understand that, then that's fine. I'm happy with that, for you to leave that in there. On the presentation disclosure requirements, folks, we should not treat the accounting standards as a checklist, and make sure we include everything that the standards have got in our disclosures. Sometimes you may find that disclosure requirement is set out in the standard, but if it's not adding any value to the users of your financial statements, it's not material to the users of your financial statements, then it does not need to be there. You can exclude it. So just bear that in mind. So there is an overarching principle in IS1 now when it comes to the application of materiality, that you'll see what I've got in there is that I've got little extracts of what is sitting in IS1 around the application of materiality. But I think for me, what's important is the one right at the bottom. When items of income and expense are material, an entity shall disclose their nature and amount separately. If something is not material, and this does not only apply to income and expenses, it applies to everything that we've got in our financial statements. So if we're saying, oh, if what we're dealing with is material, then yes, I must disclose it. If it's not material, it's not going to affect people's understanding of my financial statements. Well, can I aggregate it together with something else? Do I need to provide all the disclosures that go with it? If I don't need to do that because it's not going to affect people's understanding, then folks, leave it at that. There's no need for you to go and provide all these things separately. So an entity shall present each material class of similar items and show them separately if they're dissimilar, unless those numbers are immaterial. Financial statements result from the processing of large numbers of transactions. If a line item is not individually material, it is aggregated together with other items. Some IFRS specify information that is required to be included in the financial statements. An entity need not provide specific disclosure required by an IFRS if the information resulting from that disclosure is not material. Now, folks, I don't know how many other ways of saying this, this can be done, but all of that is saying to me is something is not material, it doesn't belong in your financial statements, so therefore don't worry about disclosing it in the financial statements. So when I go back to this practice statement that I spoke about earlier on, it was issued back in 20, it's been an issue for a while now. I think it was back in about 2017 that it was issued. In 2018, IS1 was amended to deal with, give us the new definition of materiality. And then now in February, the ISB have amended both IS1 itself and the practice statement. And the intention behind that is just to give that clarity around materiality and significance, taking the word significance out of a lot of the places where it is used in IFRS, and to enable us to hopefully apply everything with the lens of materiality, rather than trying to figure out, well, is there a differentiation between what is significant and what is material, and just driving the point home that there is no need for us to go and disclose every single thing that we've got in our financial statements. When I look forward in what we've got in the Disclosure Initiative project, the process has not stopped yet. The ISB are still carrying on with making amendments to it, but the objective still remains. They're trying to improve the information that, how the information that is presented in a set of financial statements, how it's communicated, and what they're not going to be doing is focusing on other areas of the financial statements. I did mention the primary statements and the changes that are coming there, that the ISB are looking to make some changes to. So specifically in the statement of profit or loss and other comprehensive income is, well, how do we present this document, and what is there a way that we can make this information more user-friendly and make it more relatable with everything else that we've got in whether it be on the statement of cash flows or on the statement of financial position. But basically, I think that's where they're going with it, is that they are revisiting what we've got in IS1 with the intention of making those particular changes. So some of the comments that have been received on this, and I guess which have given this project some impetus, is the investors are saying, well, subtotals in the statement of profit or loss need to be comparable between different companies. Companies should provide more granular information, and the grouping of the information must be such that it allows for better inputs for their analysis when they're analyzing this information. And other people have come back and said, well, when you look at the performance measures that you've got, the management are providing, they can provide additional useful information, but different people are doing different things. So we don't know what it is that they've done. And so there must be a transparent way of coming up with these performance measures that people have got. And we often see this. There is the one company, they thankfully they stopped doing it. But a few years ago, I won't mention who they are because I think it'll be unfair for me to just pick on one person. But they had earnings per share, headline earnings per share, diluted earnings per share, diluted headline earnings per share. They had sustainable earnings per share. They had a whole host of measures in their financial statements, and normalized earnings per share as well was in there somewhere. Never mind that we had normalized and sustainable earnings. Well, I don't know what the difference is between those two things. It was never really explained in their financial statements, but they had all these different measures. So if you are going to have them, well, can we at least understand what it is that you're telling us about, so we know how to read that information? So you'll see that the board has responded to some of these comments that have been made by bringing in additional subtotals. We don't have a definition for cost of sales as an example at the moment. We don't have a definition for what is operating profit at the moment in IFRS. But hopefully going forward, we will have some of these definitions provided in our financial statements. The disaggregation of financial information, again, that's going to come in. The performance measures, that's something that is being worked on at the moment. So hopefully we'll have a little bit more clarity in terms of what we're doing. So even with this project, having gone the way that it has, and this is what the ISB was proposing at the time, is that the income statement looks something like this. Show us what is operating, show us income that is coming from your integral associates and joint ventures. So this is basically those associate companies and joint ventures that have got a direct correlation to with what you do as an organization, and therefore are, while they may not be adding directly to operating profit, but they're certainly within the ambit of what your organization does. Can we see what the results of their operations are? That will then give us our operating profit of everything that we do as an organization. Anything that is an associate company or a joint venture that is not integral would then fit in under maybe investing activities, and then would show our share of profits and losses of those non-integral associate companies and joint venture in that particular space, where we are simply acting as an investor. If we're receiving dividend income from any plain old investments, our IFRS 9 investments, those will come in there as well. And that will then give us our profit before financing and income taxes. And then you'll see on there, we'll then have a financing section all on its own. So we've got operating, investing, financing. That is basically where their thinking was going. So this will then enable one to, when one is looking at your statement of cash flows, to see some sort of correlation between the numbers that are being reported. Now, this correlation, even having done this, the correlation was not so evident in the statement of cash flows. So again, this is one of the things that has come up as a comment to say, well, in as much as you're making all these changes, but we think that maybe you could still go a little bit further in these particular areas. So the ISB are currently investigating that to see what it is that they, what they'll ultimately then do. But we're hoping that there will be a new standard that will then be issued that takes into consideration all these various things in the next little while. There will be some other amendments to I7, IFRS 12, IAS 33 on earnings per share, IAS 34 on interim reporting as well that we're expecting coming out of this process. So folks, just for you to be on the lookout for all those things. And there will possibly then be a withdrawal of IS1 because that standard won't be necessary. Maybe we might have a new standard. I don't know, maybe it might be IFRS 18 or something that will then replace IS1. I'm surmising on, I don't know what number it is. I'm just thinking that if it's the next standard that will be issued, then that's the next number in line at the moment. But it's not a fait accompli at the moment, so I don't know for sure what the standard will be. So part of this disclosure initiative project that the ISB have been going on about for a while, the intention has been to try and take the complexity out of financial reporting, not only from the disclosures that are provided, but also just the approach that we use for the accounting. So whether one goes back to IFRS 9 and what that was meant to achieve when it first came about, or we go to where we are now with IFRS, with IS1 and all the amendments that are coming in. But the intention is provide information that is more useful, provide a framework that is robust, that is able to stand the test of time, and at the same time, try to limit the amount of volume that is sitting in a set of financial statements so that people are not lost in the detail of what is provided. So the ISB are looking at this and looking to change. So not only IS1, as we've mentioned, IS 19, we spoke about just now, IFRS 13 on fair value measurement. So they're testing their thinking in those particular standards, and hopefully coming out of that will be something that will then enable us to have a little bit more clarity in terms of what our reporting should then look like. So I'm going to skip the next couple of slides because I spoke about this already. This is just slides for you to be aware of. And then there is what I'd just like to talk about before we take a break. Now we've been going for an hour and 25 minutes now, so I'll take a break in the next couple of minutes. There's other projects that are on the go at the moment at the ISB, which is basically the third agenda consultation. It was delayed because of COVID-19, but we're expecting that the process is already starting now. I know that there are some meetings that have been set up in various jurisdictions to look at this third agenda consultation, what the ISB are looking to. So basically, they're asking, look, what should they be looking to in terms of standard setting, for the next 5 years? That's what this third agenda consultation process is all about. So for those of you who are who feel that you would like to have your voice heard on a particular matter, or you like to see the ISB working on particular projects, again, please have a look at this. They'll also be making some changes to the taxonomy. Remember, that's just the dictionary that tells us all the different definitions of the various terms that are used within IFRSs. They'll also be looking at this and the amendments that may possibly be necessary coming out of the IBOR reform project as well. So again, just be on the lookout for that. Then there'll be the post-implementation reviews of various standards. We got IFRS 5 that should be starting soon. They will be looking at doing something on pollutant pricing mechanisms. I guess for those of us who we're not really polluters, we may not be aware of this particular standard, but I think just for you to be aware that There may be some accounting framework that is coming in there that we may need to be aware of where we are polluters. They're looking at making a change to IAS 29, the hyperinflation standard, that should it only apply to entities that operate within hyperinflationary economies, or should they also be looking at high inflation? So hyperinflation is where inflation exceeds 100% over a 3-year period cumulative. Or should we be looking at countries where inflation may be sitting at 60% cumulative over a 3-year period, because that's high, and those numbers may not necessarily be comparable. If they're prepared, numbers that are prepared in those jurisdictions may not be comparable from one year to the next because of the high inflation, but it's not yet triggered that application of IAS 29. Is that right? So they're thinking about that at the moment. We do have quite a few jurisdictions around the world that are in that high inflation space at the moment, and I think this is where this particular thinking is coming from. Variable and contingent consideration in a business combination. Again, this is something that they will be looking at to see whether or not this is something that needs to be reconsidered. But again, at the moment, nothing that they're making any changes on specifically. So with the post-implementation reviews that have been done, IFRS 8, IFRS 13, those are complete. No action is going to be undertaken there. IFRS 3, that's now been completed, but they're still going to look at the business combinations under common control. And then we've got the future post-implementation reviews, which I've talked about, IFRS 10, 11, 12. I don't know why IFRS 9 is not on the slide, which should be there, and IFRS 5 as well, which they're looking to do. And then when one looks at what's been completed in the recent past, just to remind you that there's some project that the board initiated in previous years on discount rates, improvements to IFRS 8 on operating segments, the disclosure initiative project and the principles of disclosures. Those have now been completed, and you'll see them, some of them you'll see them on this list of standards that have been issued that are not yet effective, and those that are already effective. Folks, just remember that we've got a few standards that have come into play already over the last couple of years. Uncertain tax treatments, that one has been quite important for a lot of us. We've got the disclosures in our financial statements about uncertainty around the measurement of our tax liabilities. Again, where you got this uncertainty, have a look at this interpretation as well, because it does give us a little bit more guidance in terms of what it is that we should be considering in determining what that liability is going to be. Long-term interests in associates and joint ventures, where we make loans to our associate companies, to our joint ventures. Do they form part and parcel of the equity that we've got invested in that entity, or are they a financial instrument and we deal with that as a financial asset in terms of IFRS 9? This again, sometimes a little bit similar to what we've got with the FICE project, characteristics of financial instruments with characteristics of equity, is that it's not always an easy one to deal with. But as a person who has made the investment, I guess a lot of the discretion is rests with you in terms of how you want to account for that particular investment that you've made, or that particular loan that you've made. But again, this gives us a little bit more guidance in terms of what it is that we should be looking at. There's various other projects that were finalized and are currently already applicable, where you've got interest that were previously held in the joint operation. How do you then deal with the accounting for that? So if you've got any joint operation accounting and you're moving from one classification to another, have a look at that. Materiality that comes in, the definition of a business. Again, remember, we've got the amendments to IFRS 3. For a lot of us, depending where we are in the world, we probably find ourselves in a situation where if you bought into an organization that's got as its only asset, maybe investment property, it's got land and buildings, and that the land and buildings are leased out to a whole bunch of tenants. Have I bought a business, or have I bought investment property when I buy into that business? So again, because I was always very contentious, what a lot of the regulators around the world then ended up doing is that they said to entities that found themselves in this space, they required them to go and explain in their financial statements why they accounted for that particular acquisition as the acquisition of a business or the acquisition of investment property, and to explain that judgment. So in explaining that judgment, that would then hopefully clear it up. But what we didn't have was consistency of approach. So the amendments to IFRS 3, certainly on the definition of a business, would then ask us, well, are the assets of this organization concentrated in one particular asset? If they are, well, then maybe what you're buying is actually you're acquiring investment property rather than acquiring a business. So that brings a little bit more clarity to that definition of a business, and hopefully that will then enable us to then apply that more clearly across different jurisdictions going forward, different entities and different jurisdictions going forward. This one is already here, effective for all financial periods beginning January 2020. So again, just to be aware of that. We spoke about materiality and the new definition there, folks, already in force. And then the new conceptual framework, the new definitions of assets and liabilities, all of that is already in force. So again, please don't forget about that. Then we've got all the standards that have been issued that are not yet effective. Again, we've spoken about them in different sessions. So I won't go through them in any detail today, but we've got the classifications of liabilities as current and non-current. Remember, we had the change in the definition there, amendments to IS 1. We've had onerous contracts. We didn't have any guidance in terms of what we consider when we're determining what goes into a contract in terms of the expenditure to be incurred. So we got more guidance there. Property, plant and equipment, what happens where we've got proceeds from selling widgets when we're still in a test phase? How do we deal with that? That's not clear. We don't knock it off against the cost of our property, plant and equipment as we used to. COVID-related rent concessions. I'll come back to this later on towards the end of the session. And we've had a few other things that have come in. But folks, please remember all these things some of them are not yet in force, others are already in force. The COVID one is certainly already in force. So we can just remember that. Right. Folks, that's where we are at the moment. If there are any questions, I'm happy to take questions. If not, let's take a break. And my voice is starting to give up. I don't know why. But let's take a break all the same. And then when we come back, we'll deal with IFRS 3 proposed amendments. And I'll take us through some of the business combinations under common control thinking that is going to find its way into our literature. It's 35 minutes past the hour where I am. 35 minutes past the hour. Let's take a 10-minute break and we will come back in at 1:45 and we'll carry on with IFRS 3. Thank you. Right, folks, welcome back. Let's carry on. Before we went off to on our comfort break, I did say to you I would talk to you about the one thing that I'd said I would show you was that the agenda decisions and where you find them. So this one is an I-16. So if you look in I-16, right at the beginning, on the definition of property, plant and equipment, and that property, plant and equipment are a tangible asset. This is going all wonky. Are a tangible asset. You'll see on there, I've got a little E1 over there. I don't know if you can see where my cursor is at the moment, but if I highlight it over there, you'll see there. And that E1 is effectively then referring me to what you'll see on the next page, which is in that box. You'll see there is an entire agenda decision that's been published there. So already, as you're looking through the standards, if you're working with the annotated version of the standards, you can see where there's things that maybe are potentially problematic, or where there's issues that require the application of some sort of judgment, and you've done that in the past. If the interpretations committee has had somebody else ask them to say, well, we see this thing, how do we understand it? How do we apply it in practice? They might already have put something out, and they would generally put it out in the form of an agenda decision like this. So you can see exactly what it relates to and how it's been addressed by the interpretations committee. So you don't necessarily then have to go back to the agenda decision listing that we've got on the ISB's website. That one I'd recommend that you do for, if you haven't got the latest version of the standards, maybe that you may want to look at that list as well, just to make sure that you've picked up anything that might have come out in the last little while since your version of the standards was published, because it won't obviously be captured in that set of standards. So folks, that's how I would recommend that you go about dealing with this and looking at this particular matter. I hope that answers your question. Was it Colin much earlier on who asked the question as to how we figure it out? Just make sure, yeah, it was Colin that asked the question. I'm just making sure that I've got the right name. And yeah, but any problems if you struggle to try and figure out what it is that we're talking about, please give us a shout and we'll see what we can do to try and help you find the right information. All right, let's move on from there. The next topic that we are going to look at are the amendments that are proposed to IFRS 3. And the amendments that are proposed to IFRS 3, I will take us very quickly through where we currently stand with the process of applying IFRS 3. So you enter into a transaction, you acquire another entity. The first question we need to ask is, well, is this a business combination that I've got? And if your answer to that is yes, it's a business combination, this entity that I'm acquiring meets the definition of a business. Remember, with the new definition of a business, it meets the definition of a business. The asset base that we're acquiring is not concentrated in one particular asset, and the processes that are in place are integral to what this organization does. We meet all those criteria, then we can tick off that first block, and we can say, well, yes, we do have a business on our hands. We go on to the next block. Who is the acquirer? Identify the acquirer. Again, remember, we never have a merger of equals in IFRS. One of the parties that are coming together is going to be deemed to be the acquirer of the others. So therefore, we need to figure out who the acquirer is. Determine the acquisition date. Simply put, the date on which I could walk in there, throw my weight around, the date when control passes. That's my acquisition date. Generally, it's going to be a date now or in the future, never a date in the past. I then recognize and measure my consideration. So how much is it that I'm paying to acquire this business? Am I paying in my own shares as well? Are there other things that I'm paying for to try and get rid of? Maybe the other party has been suing me, and by me acquiring them, the lawsuit goes away. I can get rid of that. That may be part and parcel of what I'm paying for. It may not look like it on the face of it, but I'm trying to get rid of a potential claim that might have been lodged against me. So therefore, I'm settling the claim as well as acquiring the business. So therefore, that must be taken into consideration. And if I'm paying for this using my own shares, well, what are these shares worth? We need to be able to measure this consideration that is going to be paid. And we may find ourselves in a situation where some consideration will be paid at some point in the future, in which case present valuing may be necessary. So again, bring all those things into consideration. Then we recognize and we measure the identified assets, liabilities, any minority interests that we have, bring those in. Remember, with minority interests, we can either measure them at the fair value of the underlying net assets, or we can work on the base of the fair value of the minority interests themselves. So we're buying 80% into this company, there's 20% minorities. Well, what is that 20% stake worth in the open market? We can bring that number onto the books if we choose to, or we can bring on 20% of the underlying net assets that we've determined coming out of our PPA, our purchase price allocation process, which I'm hoping would have done appropriately. Now, coming out of all of this, so we now need to compare, well, what is it that we've paid versus what it is that we're requiring? And we account for the balancing number as goodwill or as gain on a bargain purchase. Again, nothing has changed about this process. Exactly the same as we've always had it. But in accounting for this goodwill, IFRS, or IAS 36, not IFRS 3 now, IFRS 3 would enable us to recognize that goodwill in the first instance. IAS 36 is now our subsequent measurement of that goodwill, because we're now told, well, IAS 36 then says to us, well, have a look at the various things that you got on your balance sheet. Can you identify a cash generating unit in amongst what it is that you have acquired? If it's made up of one cash generating unit or several cash generating units, when it comes to testing of goodwill, and will require you to go and test your goodwill for impairment on an annual basis, go and allocate goodwill to the CGUs that exist within your organization. And that being the smallest identifiable group of assets that are on their own able to generate cash inflows that are largely independent of the cash inflows of any other assets that make up your group of companies. So once we've done that, we've identified our CGU, would have allocated goodwill to it and so forth. And then we then test that goodwill for impairment on an annual basis at that level of the CGU. And there are some rules around that testing. Your CGU cannot be any larger than a segment that is defined in terms of IFRS 8. And the testing is always done at the lowest level at which you as management will monitor the performance of your organization. But the process that we'll then need to follow is basically 4 steps. If you're doing our impairment calculation, determine the carrying amount of your goodwill, of your CGU, including any goodwill that's been allocated to it. Determine the fair value less cost to sell of that particular CGU. Determine the value in use of that CGU. One of the two, for now, would be a great start. You don't have to do both of them at the same time. Just one of these two would be sufficient. I'd recommend that you go with the easier of the two, and the easier of the two is probably going to be fair value less cost to sell. If you've had an offer in the recent past for somebody to buy your business, well, what did they offer you? If we can work out what that number was, or the sales of your businesses that look like yours that are happening on a regular basis, or what sort of pricing models are they using? Can we use that as a basis for determining what our fair value less cost to sell would be? If we can work out what that number is, then you compare that number to your carrying to the carrying value of your CGU. If you find that your fair value less cost to sell is higher than the carrying value of your CGU, then there's no impairment issue to worry about there. If you find that your fair value less cost to sell is lower, carrying amount of your CGU, now we've got a problem. We need to go to the next step, which is, can we do a value in use computation? We're going to work out what the cash flows are. Again, this is probably a little bit more subjective, but go and work out what our cash flows are. We present value our cash flows, and then we compare whatever the outcome is with the carrying amount of our cash generating unit. If we find that the carrying amount of our CGU is still higher than what we're able to get from using the CGU, then we have an impairment issue. But impairment is then, the impairment charge will then be determined based on which of these two numbers is the higher, fair value less cost to sell and value in use. So whichever one of those two is the higher number, that's the number that we then compare against our carrying amount of our cash generating unit, and then we take the shortfall directly to profit or loss as a write down. And that will be the end of that. So we recognize our goodwill, our write downs immediately. So where a write down is required in relation to a CGU that's got goodwill allocated to it, you need to take against goodwill first. Anything else that you got left, you then have a look to see, well, are there any assets that are in there that may potentially be impaired? You then allocate against those assets. If there's nothing else that is obviously impaired, then you then take the write down proportionately against all the non-monetary assets that are sitting on that particular CGU's balance sheet. So once you've written down goodwill, remember we don't ever reverse it. Write down, once the write down happens, that's it. The goodwill is done, dusted, nothing will then change going forward. Now this is where we are now with goodwill. But I would also like to just remind you about some of the things that we may have come across in the newspapers and things over the last several years. General Electric reports a 22 billion goodwill write-off. Kraft, 7.1 billion write-off on goodwill and 8.3 billion against intangible assets. Steinhoff, 7.2 billion euro on the group's goodwill and intangible assets. Nestle, 2.8 billion Swiss francs write-off on their goodwill. So folks, this then calls to question, should we be recognizing goodwill in the first place? Is it appropriate to recognize goodwill? And I guess, one can make an argument for what goodwill is for, what its role plays on a company's balance sheet. But at the same time, there's also some examples of scenarios where that goodwill may have been misplaced and writing it off may have been an appropriate way of responding to it. So this takes me back to the older folks among us. Ami, I see you on the call here somewhere. I'm looking at you specifically at the moment. But when I look at our experiences from the past, is purchase price allocation is not always correctly done. Outside of the companies that are listed, I don't know how many of us will take the time to go and do a proper PPA in order to get the right numbers. There's going to be a lot of judgment that's going to be applied. And sometimes that judgment may be questionable. Do management really understand what it is that they're doing? And when it comes to the impairment testing, well, it's onerous. I think I just spoke through the 4 steps just now. And if I need to go and do that value and use computation, finding that information may be quite time consuming. And if I'm running a small business, I may not necessarily have the time to be able to go and do all of that as well as run the business at the same time. And oftentimes you'll find that when the impairment happens, it's a little bit late. So when I look at somebody like a Steinhoff, how many years did it take before that write-off happened? There were questions already being raised about Steinhoff back in 2013, but the write-off I think only happened in about 2016, 2017. So again, all those things would then indicate to us, well, maybe there is another way, a better way of approaching this. And also trying to understand whether or not, whether the existence of goodwill is indicative of the true worth of a company and how one can truly measure its performance. So in looking at the case for amortization that has been made, is that there's a lot of folks out there that are saying, well, if we amortize intangible assets, goodwill is in effect an intangible of sorts. So should we not be doing a similar sort of thing for our goodwill? And at the same time, whatever goodwill was on the company's balance sheet or arose on the company's balance sheet when we acquired it, that will ultimately be replaced over the years by internally generated goodwill. So is it appropriate that we retain whatever goodwill existed at initial acquisition on the balance sheet? And it's not a metric for performance of the business, of the business combination. If you are now writing things down, does it then not mean that maybe you overpaid for this business? So while it might have looked fantastic, but maybe the reality is that you actually overpaid for this for this organization. So a lot of people, I guess a lot of investors are saying, well, it's not important to them as well when it comes to their measurement of how this organization is doing. In South Africa, for example, we got what we call the headline earnings per share computation, which is what you see as HEPS there. Headline earnings per share is used in various countries across the African region as well. And in that HEPS calculation, goodwill is always added back. So any write-down of goodwill is always added back. So, again, people are looking at this and saying, but we don't understand what this thing is all about. Do we need to be considering it? And running these impairment calculations on an annual basis, it's also costly. We talked about the reporting the losses too late, and if people are stripping out these intangible assets, as they do with should they not also be doing the same thing with goodwill? So again, it's trying to understand all of this, that where the ISB has basically are going with this particular project. So they're basically looking at this and saying, look, so when we look at the disclosures that a company then provides in its financial statements, do we have the appropriate tension then between what preparers are providing and what users are requiring in order to ensure that the right disclosure is made in the financial statements? And this would mean that, if you are going to be providing any disclosures in your financial statements around goodwill, is around goodwill and how it arose. Well, what we should actually be talking about is, we bought into business X. Why did we buy into it? Why was that acquisition seen as a strategic decision on our part? And what value are we deriving from it, or what value are we intending on deriving out of it? So was it a good investment that we made? And I think if those are the key principles that on which goodwill is then premised, exists on the balance sheet, then I guess it makes sense to include it in there. But to the extent that we're not answering those particular questions at the moment. For a lot of companies, we're not answering those questions at all. We're simply saying, well, goodwill arose on the acquisition of company X, and that's it. The reason why it arose, or why we were happy to pay extra in acquiring that business, we have not explored that. The value, the return that has been generated from that investment that has been made has not been analyzed sufficiently. And I think that for me is where some of the thinking should be. So the amendment to IFRS 3 will now include the following disclosures. Something that enables us to evaluate the strategic rationale behind the business combination. Something that enables us, wording that will enable us to understand the amount of, and to evaluate the rationale behind the total consideration that we've paid in acquiring control of this organization. And to also enable us to talk about the objectives that we had when we entered into that business combination. Have we achieved those? Have we achieved those particular objectives? I've come across, and this has happened quite a few times now in the last few weeks, where you'll see companies will have, we acquired a company X in 2019. In 2021, they're already moving on, disposing of company X. And you ask the question, but why? What's happened? Why are you guys you've barely bedded down this particular arrangement that you've just entered into. Why are you walking away from it? And people are not always able to explain themselves, or don't always explain themselves in their financial statements as to what it is that has informed their decision to walk away from a transaction. Yes, and over the last year, yes, COVID has come, maybe the acquisition came at the wrong time. Maybe you borrowed money in order to finance it, and now it's costing you way too much in order to try and maintain it. And the return is just not there. But those are things that we need to understand. We need to understand exactly what it is that's informed what you're doing. So the post-acquisition monitoring of performance is going to be beneficial to the users of the financial statements, in that it holds management accountable for their decisions to enter into that business combination in the first place. As an investor, I would also like to understand, well, what is the return on investment that has been earned? Is it something that is worth my while? Or should I have pushed back when management said, well, this is what we're looking to do? Should I at that point in time should I have said, well, should I not be asking you to explain yourselves a little bit more before I give you the go-ahead to go and make an acquisition if you needed my approval in the first instance? So I guess it's all those things that are now coming in that should now come through in our disclosures. Colin, I see goodwill is a prepayment for future profits and should be amortized over the expected payback period, which is finite and should be 1 to 15 years max. I guess that would be a point of view that is out there. And Colin, I think you would certainly be a good candidate to comment on this as well, in addition to other things that you have commented on today. So that would be a positive coming out of the disclosures, that there's additional information coming in to enable users to understand why the decisions were taken the way that they are. But there's also another downside to it, is that integration of operations does not take 2 years. It takes longer than that. It may take longer than that. And again, depending on the complexity of the businesses and that sort of thing, making a decision to walk away after such a short period of time, I don't know whether or not it will always be appropriate. Or maybe it depends on the type of business that you're in. Costs and versus benefits, monitoring characteristics for for a period of time may be difficult to achieve. How do you measure success? Is what management say is their success factor the same as what I would look at as an investor? What information are they providing me with? Is the information that is in there that that they might look at and say, well, this is commercially sensitive information, so therefore we cannot share it with the users of our financial statements. It would put us in jeopardy, whittle away at our competitive advantage, so therefore we cannot disclose it. I don't know. So there may be a whole bunch of things in there that need to be taken into consideration before we then decide, well, this is the appropriate way of doing it. So the disclosure initiative in draft guidance that we've got when it comes to this particular matter is that, well, we need to have high-level disclosures that talks about the objectives behind what it is that is being done, that will prompt preparers to consider the overall information that is provided in complying with the specific disclosure requirements, and to ensure that user information needs are met over time. There will be specific disclosures as well that will underpin any disclosure requirements that are sitting in there. But this is basically the principle that the disclosures that we are providing in our financial statements need to be able to live up to. So taking this and now applying it in where we are in IFRS 3 would then result in exactly this. So I spoke earlier on about, well, if we're providing all this additional information about that will enable management to be held accountable and to enable the investors to gauge the return on investment, all of this for me is coherent, very coherent with what IFRS, with what the disclosure initiative guidance requires us to do. So as we're preparing our financial statements, we certainly need to ensure that the information that is being provided would enable the users would take the users into the confidence of the company to say, look, if we are giving this information to our chief operating decision maker to enable them to make decisions, well, we'll share the same information with you as the users of our financial statements, as our stakeholders, so that you are also equally informed in terms of what are the various things that are affecting this organization and that are affecting the decision-making process that this organization needs to go through. The whole process around, well, if we are going to get a benefit from an asset over a period of time, if we are going to amortize it, well, then, let's talk about this amortization period and how we will then deal with this amortization. Again, going back into IFRS 3 itself, that standard is already a checklist standard. It tells us this is what we need to disclose in the financial statements. Are those things material? Are those things necessary? And to the extent that we may have something that is annotated in IFRS 3 as being something that needs to be disclosed, if we find that it is not sufficient to simply disclose that particular piece of information, but there's more that is required, well, then we need to be prepared to go and provide that additional information to enable us to then understand what it is that is being done. So coming back to IFRS 3, the objectives that we've got, that we just talked about just now, we need to be able to understand, why did we do this transaction? So as we're preparing these financial statements, why did we do this transaction? Can we understand why we paid extra? Why did we say, in paying that premium, what benefits will we get? How will we get those benefits? What is this expected payback period? Colin, this is, I think, going directly down your path. What are the objectives that we've got with respect to that goodwill. If those objectives are not being achieved, then that would indicate to us that we've got an impairment issue. Now, folks, there is one thing here that I think IFRS for SMEs, even though it's the lower class standard, if you like, than full IFRS, but it's got one leg up on IFRS, is that it requires that where an entity, where an acquisition of another entity results in goodwill being recognized, the disclosure requirements in IFRS for SMEs then say, can you explain to us, as a preparer of these financial statements, why you are prepared to pay extra? And in explaining why you're prepared to pay extra, that then becomes the base for any impairment testing that is then done around that particular investment or that particular goodwill number going forward. And I think for me, that is absolutely key. And hopefully that will then, put us both on the same footing going forward in IFRS and IFRS for SMEs. So if the arguments there haven't convinced you, well, then the option is to keep the impairment model in place. And looking at, we will obviously need to look at what indicators are there. Are there any indicators of impairment? And there are some benefits coming out of that. Is that the compliance burden is not so much. In that if we're simply testing to see, assessing to see whether there are any indicators of impairment, that does not necessarily mean that we need to actually do an impairment test. But where we do then need to go the next step and do the impairment test, then there will be that additional work that will need to be done in terms of doing our fair value less cost to sell or value in use computations, cash flow projections where they're necessary, what inputs are going into the process, how are they obtained, all of that. So what the ISB is looking at doing there is that we are required to go and do all of the use this particular method. Is there a way that they can improve the calculation of value in use? And this will then mean that, when they're looking at the cash flow projections and that sort of thing, can we, do what do we include in those future cash flows that we take into consideration? Do we worry about future potential expenditure? Do we include in there any benefits that might then support this goodwill that exists on our balance sheet at the moment? What about this internally generated goodwill that we then realize that we create post the acquisition date? Also, the value in use computation themselves, do we use post-tax inputs in the calculation for value in use? So because this particular space, I think, has been fraught with disparate ways of doing it, there's more guidance that is required on this. So the ISB will potentially look at revamping that particular section if this is the method that is going to be used. So this is all contained in a discussion paper that was issued in March 2020. The period closed in December 2020. The common period closed in December 2020. I don't know, I keep saying November. December 2020. And the board is currently looking at the feedback on this. And I guess it's just for us to keep a lookout to see where it goes and how it might potentially change what we're doing going forward. But we still got an ability to comment because it is just a discussion paper. So the exposure draft process is still to come, and then hopefully there'll then be finalization thereafter. So Colin, I'm looking to you specifically to help with that, please. Something else that is on the go at the moment, I mentioned the business combinations under common control. Many years in the making so far, but where you have a group restructuring or you have a group reorganization, at the moment, IFRS 3 very categorically says to us, if you are owned by the same people before and after your group reorganization or your group restructuring, so whether it be maybe just a combination of subsidiaries of the same parent, maybe there's a transfer of ownership of a subsidiary within the same group of companies, we're simply moving company A from where it's sitting to another portion of the group. That's a restructuring. Maybe we've created a new holding company, maybe we've divisionalized, whatever it is that we've done. All of these things are examples of restructurings, reorganizations that IFRS 3 categorically says it does not deal with. So go and find some other way of addressing the accounting that is related to this. So the issue that we've got is, because these things are excluded from the scope of IFRS 3, but they frequently occur, different companies have found different ways of dealing with it. So if I give you a scenario like this, so we've got a holding company, company P, that owns subsidiary A and subsidiary B owns subsidiary C. If after the group restructuring has happened, subsidiary C becomes a subsidiary of subsidiary A, which standard am I required to look to in order to account for this? And just give that a thought for a moment. I've told you already, IFRS 3 is not the one. So which one do I look to? Answer. We don't have anything at the moment. So A can measure the assets and liabilities of C under one of two ways at the moment, either a current value approach or what we call a predecessor approach. So again, if whichever one you choose to go with, IAS 8 would allow you to go and make an accounting policy choice. Craft your own accounting policy as long as the accounting policy is based on either principles that are sitting in IFRS already, or if we've looked outside of IFRS to another standard setter, we found somebody that's got applies a similar framework to what we do as IFRS reporters, and we've used their guidance in order to get to the answer that we have. So whether you look at US GAAP, you look at UK financial reporting standards, you're looking at Japanese accounting standards, whoever, but if somebody else out there has got a different framework that we can apply, then absolutely please use that. So the current value approach would then say, well, we're bringing everything in at fair value, whereas the predecessor approach would then say, well, we're bringing everything at book value. So those numbers will be very different, completely different. Now, if I was to look at that scenario where I'm now company A looking at the accounting that I'm going to apply for my investment in company C. Company P being the controlling party, B being the transferor, A the receiving entity, and C the transferee. Any accounting policy that I'm putting in place is not going to affect the accounting that is going to be applied by the controlling party. It is looking at the accounting that will be applied by the receiving entity. The transferor, they've given up the investment in subsidiary C. Excuse me, as far as subsidiary C is concerned, nothing in their lives has changed. But for the receiving entity, they're the ones who've got the worry about, well, how do we account for this thing? And we paid, assuming they paid fair value for this thing. Well, if we paid fair value for this thing, does it then not mean that we should be able to bring everything into our books at fair value? But we've also got this hanging over our head that says, but the person that we're getting it from is our parent company. If it hadn't been for them, this transaction would not have happened. So therefore, maybe they've pulled some strings and they've had these assets move across, subsidiary C move across to us at book value. So there's all these factors that one needs to take into consideration. So this is where this BCUCC project now comes into play. So business combinations under common control, where it says, well, if you find yourself in that scenario where you've got this restructuring that is occurring, then any accounting that needs to be applied needs to take into consideration, needs to fairly reflect what has happened, and in fairly reflecting what has happened, also take into consideration who is involved in this transaction. If we find ourselves, if you look at this scenario that I've got here, where P owns A owns C, and if a new co is then established, and the new co will then have transferred to it ownership of company C. As far as the group is concerned, nothing has changed except for the introduction of new co. Everything else is exactly the same. So therefore, the accounting should not be vastly different at all. But our reality is that while it may be straightforward in a scenario like this, it's not always straightforward in every single situation. So one size does not fit every single situation. Some transactions are will be, you can apply IFRS 3 to, no problem. Other combinations that occur may not necessarily, fit in with the application of IFRS 3 at all. And also one needs to look at, is it, if I'm going to go and do a fair value accounting and that sort of thing, is it worth my while spending the time and effort getting PPAs done, having due diligences done, and that sort of thing, which IFRS 3 would require me to do? Is it worth my while doing it? It might not be. So because of that, we might not need to go and do something different. So if I find myself in a situation where maybe IFRS 3 applies, maybe in that scenario we can then apply the acquisition method, because in that scenario maybe I've got external parties also involved, I've got minorities involved in the ownership structure. Or maybe you find ourselves in a situation where we are owned by the same people 100% through and through, in which case it's not appropriate that we use the acquisition method. Maybe the book value method would be appropriate because we're simply moving money from one pocket into another pocket. So therefore, there's not very much that has changed in what we're doing. So if that is where we find ourselves, then this is where this business combinations under common control standard or amendments, depending which way the ISB decide to take it, may then be of help to us. Because it's saying sometimes it's not simply a reallocation of economic resources across the group. Sometimes because we've got these minority interests that are involved in the transaction, it may IFRS 3, applying IFRS 3 or similar thinking to IFRS 3 may be appropriate. So if I give you a simple example, if P2 and P1 are owned, I've got a common parent. Hold on, let me say that again. So if you've got two groups of companies, P1 and P2, not owned by the same people, if company C was to be transferred, ownership of company C was to be transferred to P2, as part of a business combination transaction, then in P2's books, P2 would have applied IFRS 3 as normal, fairly valued everything that is sitting in company C, and allocated a portion of whatever has been acquired to the minority interests, the NCI that we see over there. But if we find ourselves in a scenario where A and B are owned by a common parent, but what happens is that ownership of company C transfers from B to A. We're now introducing an element of additional value to the minority interests of company A, minority shareholders of company A, arising out of the ownership of company C by company A. Now, if those assets are transferred across at book value, these guys are certainly benefiting from value that they may not necessarily have paid for. At the same time, if we're transferring anything at fair value, then that enables company P to realize whatever value it needs to from company C, and enables that money to then be invested back into company B if necessary. But we would not have seen that had the transfer had happened, simply happened based on book values. So this is where the ISB is looking at this and saying, well, should we not have a different outcome depending on whether or not we have minorities, depending on whether or not we have fair values readily available for assets? We're dealing with listed companies, unlisted companies. Should all of this give us different outcomes? So I've got a bit of a decision tree here that to help us guide our thoughts. Does the transaction, if I start right at the top, does the transaction affect the non-controlling shareholders of the receiving company? If the answer is no, then this is saying, well, maybe the book value is the appropriate way of doing this. But if the answer happens to be a yes, then ask the next question. Are the receiving company's shares traded in a public market? And if the answer to that is yes, apply the acquisition method. So basically applying similar thing to IFRS 3. But if the answer happens to be a no, are all non-controlling shareholders related parties of the receiving company? If that's a yes, then we'll book value method because we're all the same people anyway. Nobody's really going to be shortchanged. But if your answer happens to be a no to that question, well, has the receiving company chosen to use a book value method and have its minorities not objected? So if our answer to that question happens to be a yes, all our minorities are happy to use this particular method, book value method. If not, we're going back to the acquisition method. Okay. Got a question from Abdul Rahman. Says on the previous slide. So on the previous slide, we were trying to do a comparison between a scenario where you got two unrelated parties that have got, so this is a before scenario where company P1 owns subs B and C, and it sells subsidiary C to P2. P2 happens to have minority interests in it. So therefore, whatever value P1 obtains from the sale of company C will be based on fair value. That's not a common control transaction. P1 and P2 are not related in any way. So therefore, IFRS 3 would apply as normal, so there'll be no issues there. The problem comes in where you have a scenario that is slightly different from that, where C moves from ownership under company B to ownership under company A. Because under company A, we have minorities there. So if we're going to move everything across at book value, as one would expect with a group reorganization, then that means that minorities are getting value from the assets in company C, which they may not necessarily be paying for. So it's not just a straightforward reorganization. So then we must have something else in the accounting that reflects the true value of what it is that the minorities are getting, and that B will then be able to benefit from if it's proceeds from sale, or P would then be able to benefit from if it's proceeds from sale. That's effectively what these particular slides were trying to highlight for us. So the last slide is basically just summarizing all of that and asking the various questions as to, well, how should we be dealing with the accounting for this, and what is the project currently suggesting? And with the project going the way that it has, again, folks, I'll suggest that we have a look at this. I know there are some places around the world where they are concerned about the direction of the project, don't like the answer that is coming up, and but please have a look at it anyway to see whether or not there's something there that we think that can be improved on in terms of just simplifying the accounting, or making the accounting more consistent across different types of organizations. The discussion paper was issued in November. It is open for comment until September, the 1st of September, so we still got some time to comment on it, but it will still be some time before we get to a final standard, because from discussion paper, we're still going to go to an exposure draft and then finalization of the standard. But I think it's something that I think we just need to be aware of, especially for those of us who may be affected by this on a more regular basis. Okay, Abdul Rahman, I hope that I answered your question there. Right. Next question topic that I'd like us to have a look at is to go back to IFRS IS1 on presentation of our financial statements, and just to look at some of the general features of financial statements. I'm going to give you a little bit of time to work through this. Please pull out your phones again. If you can have a look at the question that I've got there, or go to paulev.com /golden window 397. Don't close that page if you are doing it on the web interface, because we are going to come back to this again. I think we've got another question coming up a little bit later. But which of these things make up a complete set of financial statements? You can select more than one, because the answer is actually more than one. Ticking up very nicely here. All right, we'll need to close this off. I'll give you another 10 seconds. We are running out of time, so I need to close this off. I'm not going to give you my answers just yet. I'd like to see how you guys are progressing. Okay, 5 seconds. Okay, let's hit 300. 296. Why are we going backwards now? People taking. Yeah, we got 300. Well, we hit. There we go. We hit the 300 mark. So where are we? Oh, I'm disappointed. I like the ones that are ahead of everything else. The statement of financial position, statement of profit or loss and other comprehensive income, statement of changes in equity, statement of cash flows. The rest of them, and my notes. The rest of them, no. I am not going to accept those ones. But those do not form part of the primary statements that make up my financial statements. They may make up a set of my annual report, but they're not a requirement in terms of IFRS. And I guess here I was looking at what IS1 requires me to include as part of what I prepare as part of my annual financial statements. So my primary statements would then be, let's move on from that one. My primary statements would then basically be made up of my statement of financial position, my balance sheet, statement of profit or loss and other comprehensive income, my statement of changes in equity, my statement of cash flows, and then I have all my supporting notes. So that's basically what we've got. So the poll site doesn't allow you to remove an answer if you pick on an error. I'll have a look at that. I think it should, but apologies for that if that's probably part of the reason why we had all those additional ones coming through. Thanks, Robert. Thanks for pointing that out. We'll have a look at that and see why it's not allowing you to go and remove something if you selected it an error. But so these are my primary financial statements. But what I want to focus on today for the rest of the session is basically what goes into the notes in our financial statements. So the notes of the financial statements need to disclose the basis of preparation. It needs to provide us with any information that the standards require us to provide. So we'll have in there, our financial statements are prepared in terms of international financial reporting standards, as well as maybe you might have some jurisdictional specific matters that you need to also claim compliance with or state compliance with, include that in there. If there is any other information that is relevant to enabling us to understand what it is that you've done, include that in there. We must also make sure that there's cross-referencing between the primary statements and the notes. So we can understand, well, if you've got this line item on the face of your balance sheet related to property, plant and equipment, well, can we see the information in note 3 that talks to what makes up this property, plant and equipment? So we need to see in there a summary, well, we used to have it as a summary of the significant accounting policies covering the measurement bases that are used and any other relevant accounting policies that we've got that we're applying as an organization. But IS1, with all the amendments that have come in, the words a summary, so it says disclose in our notes, disclose notes comprising a summary of significant accounting policies and other explanatory information. The words a summary of have now been taken out. It simply talks about comprising significant accounting policies. Now, folks, you need to make that call. It's not about what the next person does. It's about you working your way through your financial statements and saying, well, when I look at my balance sheet, when I look at my income statement, these are the significant things that we've got. These are the material things that we've got in our financial statements, and this is what we are going to address in our accounting policies. We won't address anything and everything. We'll only address those things that are material to our organization. What they then did is that they also then added each entity considers the nature of its operations and policies that the users of its financial statements would expect to be disclosed for that type of entity. So have we gone and done a comparison with other people in the same industry as us? Maybe in the telecom space, have we looked to see what other telecoms companies are doing? We are in the manufacturing space. Have we seen what other people that are doing a similar sort of business to what we have are also doing? So we can understand, what additional information or how they're doing it. And is there a need maybe for us to go and add to what we're currently doing to enable us to enable this our financial statements to be a little bit more informative to the users. Now, this takes me back into IAS 8 when I'm looking at these accounting policies and how I deal with all my accounting estimates and errors, because IAS 8 is a standard that addresses all those things. And it says, when I'm selecting my accounting policy, go to the standard, it'll give me the guidance that I need. And that standard will then say to me, well, what is it that you're looking at? Is it property, plant and equipment? Is it a financial instrument? Is it a intangible asset? Well, we have standards for each of those things. Have a look to see what those standards require you to do in terms of recognizing and measuring these particular assets, these particular liabilities. Now, folks, the long and the short of all of this is that what I would expect to see in your accounting policies is initial recognition and measurement of my asset liability, subsequent recognition, subsequent measurement of my asset, my liability, recognition in our accounting policies to the extent that they are relevant in that particular financial reporting period. Now, don't go and bring in policies on intangible assets when you don't have intangible assets. If you've got something on the face of your balance sheet, if it's material, well then yes, let's provide an accounting policy that goes hand in hand with it. If you've had a change in accounting policy during the year, let's understand what that change is, what's informed it. Is it a change because the standards have changed? Is it a change because maybe we've chosen to make a change? Whatever the rationale is behind the change, let's understand what it is that's informing that particular change. If we've had a change in accounting estimate, again, I'll come back to this a little bit later on, we need to explain this. What has happened? An accounting estimate talks to a monetary item that we've got on our balance sheet that where the recognition and measurement, we're given some guidance on there, but there is some leeway in there that says, well, because we are going to be using fair values or we are going to be determining useful lives or whatever it may be, there may be judgment that needs to be applied, and one entity's judgment is going to be different from another entity's judgment. Now, all of this, folks, is coming out of what we have in IAS 8 here, because you'll see in there where you do apply judgment, are you using reliable, relevant information? Whatever accounting policy you apply, please make sure that you're applying it consistently from one year to the next. If we're having to go and craft our own accounting policy, we have an implementation hierarchy, which I spoke about under IFRS 3 with the business combinations under common control, where I said, well, what happens where you don't have an accounting framework, accounting guidance in IFRS, and we need to look elsewhere. If we don't have any guidance ourselves, we fall back on other standard setters, fall back on industry practice. We spoke about that as well. But whatever we do, once we've chosen accounting policy, consistency of application, if the standards do allow us to make a change, you apply the transitional provisions that are in there. Generally, we'd be required to go back in time, go back and restate what we've previously shown in our financial statements. If the standard, if it's IAS 16 as an example, on revaluations of property, plant and equipment, that's a prospective change. So again, there'll be various rules that will be in the standards that we need to apply. If we can't go back because the information doesn't exist, then maybe we may be allowed to apply standards fully prospectively, because it is impracticable for us to go back in time. If we are going to make any changes to what we've previously shown, ask the question, is it material? If it's not material, then folks, leave it. Make the change in the current period and you move on. Now, the issue that we've got is the amendments that have been made to IAS 8 relating to accounting estimates. So what IASB have done, this is in February of this year, is that they made a change to the standards with the intention of drawing a distinction between changes in accounting estimates and changes in accounting policies and the correction of errors. So the current version of the standard doesn't provide us with an adequate definition of what an accounting estimate is. So it created that gray area for a lot of companies as to, well, if I change my way of measuring my inventory as an example, if I was using average cost method before and I wanted to go to first in, first out, is that a change in accounting policy or is that a change in accounting estimate? Now I'll let you answer that for a moment in your own head. So the application of IAS 8 became quite difficult when it came to those sorts of conundrums that one might be faced with. So what they've done is that they've introduced this additional wording into this definition, and they said, look, any monetary amounts in your financial statements that are subject to measurement uncertainty are accounting estimates. So to clarify how this then interacts with everything else that we have in ICE 8, they've introduced this wording here, and I'm going to read it all now to just make sure we all understand it. An accounting policy may require items in financial statements to be measured in a way that involves measurement uncertainty. That is, the accounting policy may require such items to be measured at monetary amounts that cannot be observed directly and must instead be estimated. In such cases, an entity develops an accounting estimate to achieve the objective set out by the accounting policy. Accounting estimates typically involve the use of judgments or assumptions based on the latest available reliable information. Now, folks, these are all things that we spoke about just now when we were going through this slide here. Is that, do I have sufficient information? Do I have adequate information to enable me to determine what the carrying amount of this number is? And if I don't, well, then am I not dealing with a monetary, with an accounting estimate, because it's subject to measurement uncertainty. So in giving us guidance on this, so the amendment now provides guidance on the use of the measurement techniques and inputs to develop accounting estimates, and it incorporates in there the fact that we've got valuation techniques, got estimation techniques that are open to us. It clarifies that not all estimates will meet the definition of an accounting estimate, but may rather refer to inputs that are used in developing those estimates. And it clarifies that the impact on an accounting estimate of a change in an input or a change in a measurement technique is a change in an accounting estimates if they do not result in the correction from a correction of prior period errors. So as long as you've done things appropriately in the past, then you're not dealing with the correction of a material prior period error. And even then, you might have made a mistake in the past, but if it's not material, then folks, don't worry about it. Let's do it properly from now going forwards. So they've got a few examples that have come in, and I've given you these in your material so you can read them at leisure. But the one deals with the fair value of an investment property. The fact that you've decided you're applying fair value, you're applying IFRS 13, and IFRS 13 gives you different ways of determining fair value. If you move from one method of determining fair value to another, that's not a change in accounting policy. That's just a change in your estimation of what fair value is. So that's one example. Another example that's also been given to us is around the measurement of a cash settled share-based payment obligation. Again, our remeasurement of that liability, taking into consideration maybe new information that comes our way. That's not changing our estimation. That's not changing the policy. It is changing the estimate. So therefore, treat that as a change in accounting estimate. All of this is going to be effective for periods beginning on or after 1 January 2023. You are not early adopted, so I would suggest that I think we have a look at this, where we got these uncertainties that may exist in our situations. Have a look at this, because I think that may help you resolve some of the issues that you might be struggling with. Okay. Right. Are there any questions from anybody here? I don't see any questions coming through on the chat, but please do type them in if you do. I'd like to look at standards issue not yet effective for a moment. What is that? Okay, standards issue not yet effective for a moment. ICE 8, again, sticking with ICE 8, ICE 8 says to us, disclose in your financial statements. Disclose in your financial statements. Abdul Rahman, I think I may need to take this with you offline, because we've got 15 minutes left, and for me to be able to explain, I don't know whether or not if anybody else has got the same question, because I didn't see any other questions from anybody else. But I'm happy to talk to you after this, if you don't mind. Maybe just dropping me dropping a mail on the support email address, and I will get hold of you after this. Okay. So now look at standards issue not yet effective. The standards say to us, when it comes to standards issue not yet effective, we are required to go and disclose in our financial statements what standards have been issued that are not yet effective, that we're not yet applying as a company. disclose the fact that the standards have not yet been applied, disclose information we've been able to estimate about what impact those standards will have on what we are disclosing in our financial statements, as well as the normal things, the name of the standards, when we expect as an organization to start applying it, and when the standard itself becomes applicable. Now, in taking that on board, I'd like you to have a look at this just for a moment and see if you can answer that question for me. Do you need to disclose all standards issued that are not yet effective, or only those that are applicable to your organization? What do you guys think? You can pull up your phones there and see what our answers are on this. Right, I'll do 10 more seconds, then we need to move on. 5 seconds. Where's everybody today? Got a 43 responses out of 160 people. All right, I am going to close off the poll. All standards issued not yet effective need to be disclosed, with 9% there. Only the standards that are not yet effective are expected to materially affect the company. And I'm going to lock it as well, so we don't make any changes there. And all standards issued not yet effective that are applicable to the company must be disclosed, including those that are not expected to materially affect the company. I guess those two have been the two that are most popular, the 57% and 35%. Folks, I like the middle one. If you'd asked me this question 10 years ago, I probably would have gone with the 35%. But if it's not material to my organization, why should I be worrying about it? Again, going back to what we've got in IS1, IS1 says to me, is this thing material? And if it's not material to my organization, then I should not be worrying about it. So the amendments to IS1 say to me, I need to disclose the material accounting policies. It doesn't talk about significant anymore, it talks about material accounting policies. And included in those material accounting policies will then be this concept of we've got changes coming our way from what that we're anticipating in our accounting standards. And if those items will not, if those changes will not have a material impact on our organization, well, then we should not be worrying about the disclosure in our financial statements. Can go to practice statement number 2. As much as I said to you earlier on, it's not mandatory that you apply it, but I think it's important that we understand what is sitting in there, because that provides us guidance as to how we apply the concept of materiality to our accounting policy disclosures. And I'm going to give you a bit of a summary here of some of the things that it talks about. An entity is now required to disclose its material accounting policy information instead of its significant accounting policies. So we've got several paragraphs in there that have now been added that give us examples as to how we can identify what is material. And we've got examples in there of what policy information is also likely to be material. And it says the accounting policy information may be material because of its nature, even though the numbers themselves may not be material, but the nature of the item is what makes it material. So I find myself in a situation a couple of years ago with a client of mine, somebody who's on the call right now, where their provisions numbers dropped dramatically from one year to the next. Materially or quantitatively, the numbers were not material. So therefore, the thinking would have been, well, let's take out the provisions note accounting policy because we don't need it. But it was material in their context because they're in an environment where they need to have significant rehabilitation provisions on their books. So therefore, that becomes a material qualitatively matter. So therefore, they needed to still deal with it despite that. Again, the amendments clarified that accounting policy information is material if users of the entity's financial statements would need it to understand other information that is presented elsewhere in the financial statements. Or if we find ourselves in a situation where maybe we are looking at more than one accounting standard dealing with the same matter. So maybe it's an IFRS 3 matter, an IFRS 10 matter, maybe there's a IFRS 12 as well. So because we're trying to weave a thread between many different accounting standards in terms of how we recognize and measure a particular asset or a particular liability, that may then mean that, well, we need to have some disclosure in there to enable people to understand what it is that we're doing. But I think the one thing that we need to bear in mind is that we should ensure that whatever information we're providing in the financial statements will not obscure will not obscure other material information that is provided in the financial statements, and that the users of the financial statements will still be in a position where they're able to understand what is it that we're doing, why is it that we're doing what we're doing. So while there was no definition of significant in IFRS and it's been replaced with material, this now is a lot more is defined. We are aware of it. Accounting policy information is material if, when considered together with other information that is included in the entity's financial statements, it can reasonably be expected to influence decisions that the primary users of the general purpose financial statements make on the basis of those financial statements. Folks, I think that's something that I think we should all be au fait with. There's no this change already came in, I think, a couple of years ago, so then we should be aware of this. Gary, your question, if a policy is material in relation to a disclosure in the comparative only, is it still required? Yes, it is, because it still relates to the set of financial statements that we are dealing with at the moment. But you'll find that when we go into the next financial year, in that year, because if there's nothing else that's left on the financial statements that it relates to, then you can remove it. But certainly for the current year, the fact that you might not have a number in the current period or a material number in the current period, but you have a material comparative, says, well, our accounting policy must remain in place for now. So in applying this definition of what is material, again, there is some guidance in there. So the amendments highlight that have been made to IS1 and to the practice statement basically say to us, look, the fact that we've got an accounting, we have an accounting policy that's been crafted in the past related to a particular number that we've got in our financial statements, it does not necessarily mean that having the policy in place will then enable people to understand what is going on in the financial statements. If it's not adding very much value to how they read, understand the financial statements, then maybe it may be worthwhile removing it. There may not be a need for us to have it in there. But at the same time, like I said, is that you may find that it may point to something that is qualitatively material. So we need to make that sort of judgment call and then decide, well, what do we keep? What do we remove? The amendment that's been made acknowledges specifically that disclosure of immaterial accounting policies may be acceptable, though it is not required. So folks, if you feel that you want to include something in there because it enables people to understand what's going on, even though it may not be material, you can do that. But I think have a look at it again in the following year to see whether or not you're not simply adding more trees to the forest, and people cannot you're now obscuring information that is necessary by providing all of this additional material information. Again, there are various examples that are given to us in terms of the sorts of things that we need to consider in applying the definition of materiality. Have we had any changes in accounting policy that have resulted in a material change to our information that we're providing in the financial statements? Excuse me. Have we had a change in accounting policy that is permitted by IFRS that is resulting in us having to go back and make changes? Is there maybe difficulty in people understanding the transactions that have been undertaken if we don't have sufficient guidance, sufficient narrative around the transactions themselves? Those are the sorts of things that I think one would inform one as to whether or not we should be adding more disclosures in our financial statements around these accounting policies. And if we're comfortable that that's what we've done, then we should be okay in terms of our application of what is sitting in the revised IS1 and the revision to the accounting policy, so the materiality accounting practice statement. That's the word that I'm looking for. Folks, we got 5 minutes left on our what's it, training session this morning. If anybody needs to leave, please don't feel the need to stick around. I've probably still got another 10 minutes or so to run, so I am going to go a little bit over time. But if you, like I said, if you do feel that you need to leave at 12 o'clock, then on the hour, realize we're all in different time zones, on the hour, then no problem at all. So what will then be required of us is, from a disclosure perspective, is provide information that enables information that is more useful to the users of our financial statements based on our own circumstances as an organization. So it's not just about, like I said to you earlier on, have you compared yourself with other organizations in your space? If you have, then that's all well and good. If you have not, well, can we understand what it is that you've done and how it is that you've arrived at the answers that you have? But I think you need to benchmark yourself against what other people are doing in order to ensure that you're doing something that is appropriate, something that enables people to understand what is going on within your organization. So the practice statement itself has been amended to say to give us a source of information that one must consider in determining what a material accounting policy is all about. It talks about, is the information necessary for users to understand other material information? Are we in a jurisdiction where maybe our local accounting standards require that we provide this particular piece of information? Is there complexity in the accounting standards that needs to be explained further? If there is, then provide that additional information in there. So the expectations coming out of all of this is that hopefully we'll have more streamlined accounting policies. We won't have lengthy accounting policy disclosures. We'll have more to the point accounting policies where we're using judgment. Then we've got clarity in terms of what that judgment is, and boilerplate accounting policies, those will disappear. Whatever it is that we're doing will be more tailored to suit what we are doing as an organization. Folks, all of this becomes effective in 2023. So as much as 2023 is the date that we have on this, my suggestion to you would be, please go and have a look at this and see whether or not we can start applying this. Have a look at that practice statement number 2 as well. It's not mandatory, but please have a look at it, because I think it will certainly be informative in terms of the sorts of things that we need to be considering in the accounting for this, in putting together our accounting policies in our financial statements. Are there any questions from anybody at this point in time? I don't see any questions. I think the last one was from Gary. I have not seen anything else that has come through. Okay. And the last thing that I'm going to do for today, just a reminder about our COVID-19 related rent concessions. This was an amendment to IFRS 16, which has already come into play, became effective, I think it was June last year, already 2020. And when you are looking at your accounting as a lessee, you need to determine your liability first of all, and that liability will then inform what your right of use asset will then amount to, that you'll then reflect in your books. So that's effectively the long and the short of our initial accounting. So look at all the payments that are still to be made in respect of the lease arrangement that you've entered into. Well, do I have a lease? First of all, if I do have a lease on my hands, what are all the payments that I need to make? Present value all those payments, that gives me my lease liability. Once I've determined what my lease liability is, that then becomes my first starting point for the remeasurement of my asset. I add on to that asset any payments that I'd made prior to that, to day one of my lease arrangement. I put all of those in there. If there's any other expenditure that I incur in order to create this, to add to this right of use asset, I add that onto my cost of my asset. And then we basically got an asset and a liability that we then account for. Subsequent measurement, I increase the carrying amount of my liability to reflect the interest. Remember, I present valued everything. So therefore, there will then be an unwinding of that discounting. So I'll increase the carrying amount of my liability to reflect the interest on that lease liability. I reduce the liability by any payments that I then make. And I remeasure the carrying amount of my liability by look at any reassessments that may be necessary, or any lease modifications that may be required. Maybe we've gone and we've renegotiated our lease with our landlord. Now, all of these things are principles that we have in IFRS 16, that we had in IFRS 16 prior to these amendments that we've had. IFRS 16 also talks about what lease modifications are, and it says a change in the lease scope or consideration that was not part of the original lease. If we're focusing on the scope, change in the right of use that is conveyed to the lessee. If we look at consideration, we're looking at the payments that are going to be made, and if there's been any changes in the overall payments that are going to be made in terms of those leases. And it talks about modifications. It says, look, a lease is modified if there's going to be a revision to the lease term, to the payments, maybe to the discount rate over the remaining lease term. And where we've got these adjustments that occur that will reduce the scope of the lease, then we'll need to go back and adjust the right of use asset to reflect maybe partial or full termination. Maybe some of us, because of COVID, have had to let go of our premises. So all of that, we'll talk to a partial or maybe a full termination of our lease arrangement, and we then recognize a gain or loss on termination in P&L. That's what IFRS 16 requires of us. But specifically, or maybe we could have an increase in the scope. Maybe we take up more space because maybe our business is booming because of COVID. And we're now having to go and we're starting a section that makes masks and sanitizers and whatever else we are making. And therefore, because of that, we've taken up the factory shelf that is next door to us, if that's what we have done. So we are amending the lease arrangement. But for those of us who've had some sort of lease payment holiday or some sort of change been made to the terms of our lease account of our leases, then IFRS 16 has been amended to deal with some of these issues. And there is guidance in there that talks to this. If economic relief is provided to a lessee that impacts the payments, but not the scope of the lease, this would be a modification, and the lessee would remeasure the liability by discounting the revised lease payments by the revised discount rate. That's ideally what we should be doing. And you make an adjustment against your right of use asset. But the problem is, a lot of us have moved on to IFRS 16 the year in 2019, and now in 2020, you're now asking us to go back and redo all of this all over again. That may be a significant amount of work. So what the ISB then did is that they said, look, we'll introduce a limited practical expedient that will allow you not to go back and do this whole reassessment process and treat this as a lease modification. So, but you need to ensure that the changes in the lease payments that you are going to be required to make will either will not result in a change to the lease that is greater than where you currently are. So basically, the change that is resulting is substantially the same or less in terms of consideration that you will have to pay, and any reduction in payments that is going to be made, those payments will originally have been due on or before 30 June 2022. Folks, this date was 2021 before. It has now been extended for another year to 30 June 2022. So while we talked to you about this particular rent concession amendment last year, so all we're doing now is that the wording remains exactly the same, but it's been extended for an additional year. So there's nothing else that changes about what is included in here. So if you do decide to apply the expedient, then please go and explain to us that that's what you've done. We'll need to then understand if there's been any extinguishment of any debt, how much has been extinguished, if there's been any changes in the pattern of your amortization, let's understand that. If you are applying the expedient, you disclose the fact that you're applying the expedient, but for lessors, there is no change at all. For lessors, things remain exactly the same as they've always been. But that's basically all we have to cover for today. Then if anybody has got any questions for me at this point in time, I don't see any questions coming through. And thank you very much. I see most of us have stayed on. That is great. This is basically what we covered today. We've looked at the amendments. I think some of the projects that are on the go at the ISB at the moment. Colin, Onele, there's a few other people that I can think of. Tanya, I think you guys need to be thinking about commenting on some of these projects, because I think they affect some of the things that you guys are doing directly. And remember the amendments that we've had to the recent amendments to IFRSs that will come into effect 2023. But I think that these are things that are quite important to what we're doing, and certainly would enable us to have some clarity in some of the things that may be problematic at the moment. Thank you, Tatius. Thank you, Mark. See your comments there. Thank you, Charmaine, as well, and Louise. Jeepers. And thank you, everybody. See, everybody's coming through now. Thanks very much for participating, and we'll see you all shortly, soon, I'm sure in the near future. Thanks. Take care.